How is everyone doing tonight? You are in the strategy room here with the banker next door, your host, Dr. Joe Berquist. So, on this Saturday night, April 11th, 2026, and I hope everyone is having a great weekend out there so far. This is actually one of my favorite weekends of the year. This is Masters weekend, and I hope if anybody was watching just a few minutes ago, Rory McIlroy finished up the final round, still tied for the lead. It was a little bit of a rough day for him out there. He had an amazing day yesterday, but today was a little bit rougher out there. But still hanging in, tied for the lead. He's going to be in the final pairing tomorrow at the final round. I would take that every time. If I was in the Masters tournament and they said you were going to be tied for the lead in the final pairing going into the fourth round, I would take it. I would take that every time. So again, setting up for another great Master Sunday tomorrow. Shocking, right? A banker that loves golf, right? I know that's shocking. I know that nobody saw that coming, right? All right. So, I've got another great, fantastic evening for everyone here tonight. We're going to be looking at a lot of different stuff. More news on SpaceX with their IPO coming up. We're going to talk about that a little bit. Now we've got Elon trying to partner up with Intel on his chip factory. So that's very interesting. We're gonna take a look at that a little later. Jamie Dimon came out with his annual shareholders letter, which is always kind of a big event in the banking space. So we're going to take a look at, what were the 5 things that Jamie was looking at this year? What are some of the things that he's really concerned with? We're going to take a look at the Iran war or conflict, however you want to describe that right now, as far as what effect that is having on the markets, on oil, some other thing, fertilizer, some of the other things with that. We got a lot of economic data this week. We're going to be looking at the CPI, the PCE, consumer sentiment, a lot of different economic factors coming into play now. So we're going to go through all of that as we go in there. Of course, I've got a ton of banking news, updates on all kinds of stuff for everybody tonight. Prediction markets, private credit, bank charters, the new de novos, got all kinds of good stuff to talk about here tonight. So let us get in with our normal stuff here as we normally do. I always like to start off with the U.S. debt clock and basically show everybody where we got. So in the upper left-hand corner there, you could see we are cruising at $39.1 trillion in national debt. The U.S. federal government spending is at $7.1 trillion, with the U.S. federal budget deficit still hanging out at about $1.681 trillion. So still to the negative. Tariff revenue still showing at $355 billion, with revenue per taxpayer of $3,247. The debt to GDP is sitting at 124, almost 125%. That is a bad number. That's just a bad number. Not what we're looking for here. And the sad thing is that basically it is only going to take this about a little over 3 months. It takes about 100 days for every $1 billion that gets, every $1 trillion that gets added on now. So sadly, in just another few months, we'll be up to $40 trillion in the national debt at the rate that this is going. The interest on the national debt is sitting at $996 billion, just a hair under $1 trillion. I'm sure that will get up just a little over $1 trillion here in the next few months, especially as we get closer to hitting the $40 trillion mark. Defense spending at $934 billion. But as I had mentioned last week in the president's budget, he's looking to up this up to about $1.5 trillion. So we'll see. We'll keep an eye out for that. And then credit card debt still circling in at $1.3 trillion in credit card debt. That equates to $8,269 per credit card holder. So just some of the typical things that we look at. And now let's take a look at some of the numbers here as far as interest rates go. So let's take a look at the bond yields. 10-year Treasury came down just a hair this week. It's now sitting there at 4.340%. We were up about 4.4% last week. So coming down a little bit as the news of at least a negotiated peace coming into play here. So we'll take a look at that and we'll see what happens with that here over the next week. But I'll have a few more comments on that in just a moment. But again, all these short-term treasury bills, as I have pointed out, still staying in a very tight bandwidth. The 1-year T-bill still sitting at 3.69, with the 6-month at 3.71, the 3-month at 3.68, the 1-month at 3.645. So again, all of these bills sitting in the short-term T-bills just sitting in a very tight bandwidth there, which again, just very, very interesting. So we're going to continue to keep an eye on that. But I think the good news here, if you want some good news to take away here, that is that the rates have not spiked out of control. Things are not crazy. The one thing that bothers me that I'm really keeping an eye on here is the 30-year bond, which is just about, just a hair under 5% now. We're at 4.917%. So obviously if that hits 5%, that's not a good thing at the moment. So that's the one thing I'm really keeping an eye on. But I think as long as the treasuries kind of hold here, if we can hold this around 4.3%, I think that's a win. I think that's a huge win, and hopefully this whole situation with Iran can at least come to some kind of negotiated peace here in the next few weeks. We'll see. We'll continue to keep an eye on that, but that's where we're at standing there. Now let's see here. Stocks. Dow Jones Industrial Average was down a little bit this week, but it did have a very good week for the most part. It was down, I think, 3 weeks or 4 weeks in a row. Had a nice comeback. It was down a little bit yesterday, but it was up for basically the last like 5 or 6 trading days. So again, doing a little bit better there. It was down to about almost like 45,900. Now it's back up to 47,916. So not doing too bad there. Same kind of deal with the NASDAQ and the S&P 500, both back up a little bit there. So that's pretty good. Cryptos here. Bitcoin did go back over 70,000. It's back up to 73,360. Ethereum back up a little bit here at 2295. So again, Bitcoin kind of getting over a little bit of a resistance level there at 70,000. So that's good to see there. We'll see if Bitcoin will continue to kind of come back. I think that Bitcoin is kind of stuck there until the crypto legislation works itself out. But as we will see later in the show, we did get a lot of updated crypto on the at least a lot of news on the crypto legislation front came out. A lot of continued proposals from the FDIC and the Treasury came out this week. So we'll get into all that a little bit later in the show. Commodities here. Again, a little bit of good news. So the crude oil and the Brent oil futures back down under $100. So that's really good. That's actually great news. So crude oil basically cruising at 95.63 right now, and the Brent crude futures at 94.26. So again, I think anything at the moment, anything under $100, I think is a win. That's great. We saw gold futures kind of bounce back a little bit at 47.71 this week. Silver futures bouncing back a little bit to $76. So again, the world isn't ending right now. That's the good news. That's the really good news. Things are really holding kind of stable for the moment. So, but we will see if this holds. I think that's the big thing. I think a lot of people out there are kind of holding their breath a little bit, but this was at least in my view, this was definitely a more optimistic week. That's for sure. There was definitely you could see some optimism, a little bit of light at the end of the tunnel. And I'll share a couple articles on that with everybody in just a second. But let's look at this for just a second. So volatility is the new norm for government bonds as interest rate uncertainty sees yields whipsaw. So government bond yields moved higher on Tuesday, reversing course amid renewed uncertainty over inflationary pressures and the outlook for interest rates in Europe. A rebound in oil prices has put the fragility of the U.S.-Iran ceasefire agreement in focus, and market strategists remain split over the prospect of further rate hikes in the region as near-term price pressures loom. So again, this is just kind of par for the course of what we saw this week, with a lot of volatility in bond pricing. Again, kind of par for the course, if you will, with just the geopolitics of the moment and what's going on. But like I said, not feeling too bad, as again, we're kind of holding in this bandwidth. Like I showed you on the 10-year here at this 4.34%. So again, I think if as long as we kind of hold it here, then it won't be too bad. And then hopefully in the next few months, as things kind of settle down, this will begin to move itself back closer to 4%. So, but we'll keep an eye on that. But let's do an update on mortgage rates real quick. So mortgage and refinance interest rates as of today, late April 11th, 2026, rates continue dropping amid Iran ceasefire. So mortgage rates have declined 5 days in a row. According to the Zillow Lender Marketplace, the current 30-year fixed rate stands at 6.15%, down 7 basis points since last weekend. Meanwhile, the 15-year fixed rate is down 8 basis points from last weekend to 5.64%. So that's great news. So mortgage rates here, 30-year fixed at 6.15. I mean, 6.15 is considering, I think if you take a step back for a second, you just kind of consider everything that's happened here over the last 5 weeks. To be sitting here, I think today at 6.15, I think that is actually a little amazing, because it could have been a lot worse than that. We could be looking at, the 10-year treasury at like 4.75, 30-year fixed rates over, back up to 7%. So I think that having the 30-year right now at 6.15, just a little bit above a little bit over 6%. I just think that in a very real way is basically like a win. 15-year fixed is at 5.64%. The 5/1 ARM is at 6.44% right now. And then on the refinance rate side, the 30-year fixed rate is at 6.26%. The 15-year fixed is at 5.74%. And the 5/1 ARM is at 6.39%. So again, I think interest rates, again, we'd like to see them perhaps a little bit better than what they're doing right now, but not catastrophic. Again, everything is okay for the moment. Everything's just kind of holding steady, and that's good. That's again, I'll take for the moment. I will take it. It's definitely a win at the moment for all the consumers out there and anybody looking to buy a house during the spring selling season here. So that's all good. So. However, we have this. Home buyer mortgage demand drops annually for the first time in over a year as war fuels uncertainty. So the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances decreased to 6.51% from 6.57% last week. Applications for a mortgage to purchase a home were 7% lower than the same week 1 year ago. Applications to refinance a home were 4% lower than the same week 1 year ago. So again, I think this is all to be expected here. So, but let's read this for just a second. So mortgage rates finally ticked a bit lower last weekend, but not enough to help the ailing mortgage market. Economic uncertainty fueled by the Iran war is keeping rates elevated and home buyers on the fence. As a result, total mortgage application volume fell 0.8% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Applications for a mortgage to purchase a home rose 1% for the week, but were 7% lower than the same week 1 year ago. That was the first year-over-year decline since January of 2025. However, certain loan types and geographic segments are faring better than others because of lower rates on ARM and FHA loans, as well as growing housing inventory of some local markets, said Joel Kahn, an MBA economist, in a release. Applications for FHA purchase applications were up 5% over the week, supported by the FHA mortgage rate being about 30 basis points lower than the conventional mortgage rate. So applications to refinance a home dropped 3% for the week and were 4% lower than the same week 1 year ago. That was also the first year-over-year decline for refinances since January of 2025. Many potential refinance borrowers have been frozen out by the sharp increase over the past month. The pace of refinance applications was at its lowest level since December of 2025. So again, we'll just keep an eye on this and see what happens. Again, I don't think that there's anything here that is catastrophic. And again, going from 6.57 to 6.51% for conforming loan balances, again, I don't think that's not horrific. That's not the worst thing in the world. And I do think that again, if we do get this ceasefire, if things kind of smooth over, all this will be fine. The rates will calm down. Things will come back down to around 6%, maybe a little bit below 6%, and then everybody will be happy again. And then this will all continue and pick up. But I think that this is probably the best news that we could hope for right now. And I think that this will certainly help. I mean, having the mortgage rates again back at like the 30-year mortgage back at like 6.15, that is very good news. And that's good news, especially now, April, May, June. This is the prime time for for the residential realtors out there who are in the thick of the spring selling season right now. So this is not the greatest thing ever, but it's certainly by far not the worst thing ever, and this will certainly help. So like I said, we'll keep an eye on all that. Now, I want to get into this because this was huge. This was very, very, very big. Now, I want to read, before I jump into this, I just want to read this one little blip I got here. So, bank CEOs gathered in an urgent meeting called by Treasury Secretary Scott Bessent and Fed Chairman Jeremy Powell in Washington on April 7th to be warned of the greater cyber risk posed by Anthropic PBC's new AI model. Mythos on the financial industry. Bloomberg News reported, citing people familiar with the matter. A Fed spokesperson declined to comment, and a Treasury representative did not immediately respond to a request for comment, according to the report. So now, and then we got this, which came out yesterday. So this was on the 7th. So this was on Tuesday. They had this big emergency meeting, and you had Powell and Bessent. Again, keep in mind, these two not necessarily besties at the moment. These two not really getting along too well at the moment, but this was so urgent that they basically put all their issues, everything aside, and basically said, hey, we got to call this urgent meeting, and we've got to get the heads of all of the major banks there. The only major CEO that was not there was Jamie Dimon, and Jamie Dimon was off. I don't know. I guess he had more important things to do, whatever. But every other major bank CEO was there at this meeting. That's how important this meeting was. So you have Anthropic. They have this Mythos AI, and they're basically got this major threat here. So Fed Chair Jeremy Powell and Treasury Secretary Scott Bessent met with the heads of major U.S. banks to discuss the cyber threat of Anthropic's new Mythos model. Anthropic rolled out Mythos this week in a limited capacity over concerns that hackers could exploit its capabilities. JP Morgan's Jamie Dimon was the only major banking CEO who could not attend the meeting. So the bank heads were already in Washington, D.C. for a Financial Services Forum board meeting when a special gathering was called on Tuesday to discuss Mythos, according to people familiar with the matter, who asked not to be named in order to share information about a confidential matter. The CEOs had a dinner earlier in the week when they were called to meet at the Treasury Department, one of the people said. JP Morgan's Jamie Dimon was the only major banking CEO who could not attend the meeting. But again, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, Wells Fargo, all in attendance. Bloomberg and the Financial Times were the first to report the meeting with bank executives. The Federal Reserve declined to comment to CNBC. The Treasury Department did not respond to a request for comment. The surprise meeting between the bank chiefs and the two most powerful federal monetary regulators was a signal that the advanced capabilities of AI are a top concern in the Trump administration and could threaten the foundation of the U.S. financial system. Earlier this week, Anthropic rolled out the new artificial intelligence model, Claude Mythos Preview, in a limited capacity due to concerns that hackers could exploit its capabilities. Banking giant JP Morgan was among the initial launch partners for the cybersecurity initiative known as Project Glasswing. Other partners include Apple, Google, Microsoft, and NVIDIA. Ahead of the release, the company briefed senior U.S. government officials on the model and its offensive and defensive cyber applications. An Anthropic official told CNBC that it's been in ongoing discussions with the U.S. government, including the Cybersecurity and Infrastructure Security Agency and the Center for AI Standards and Innovation, about Claude Mythos Preview's cyber capabilities. The dangers of getting this wrong are obvious, but if we get it right, there is a real opportunity to create a fundamentally more secure internet and world than we had before the advent of AI-powered cyber capabilities, CEO Dario Amodei wrote in a post on X accompanying Glasswing's rollout. I'm going to come back to those comments in just a second, because some of that stuff in there is insane. But we'll come back to that for a second. Let's just finish this for a minute. So, the Trump administration's engagement about the Mythos model comes as Anthropic challenges the Department of Defense over its recent labeling of the AI lab as a supply chain risk to national security. President Donald Trump and Defense Secretary Pete Hegseth have publicly lambasted the company for insisting on limits to the use of its AI technology in war, and the president ordered federal departments to halt use of Anthropic's platforms. The DoD has continued to use Claude during the Iran war, CNBC previously reported. This week, a federal appeals court denied the company's request to temporarily block the blacklisting. In March, a federal judge in San Francisco granted Anthropic's request for a preliminary injunction in a separate case. The dual rulings mean Anthropic will remain barred from DoD contracts, but can keep working with other government agencies while each legal challenge moves forward. Late last month, cyberstock slumped after Fortune discovered a blog post from Anthropic, which revealed the model's advanced cyber capabilities and possible risks. Hackers have used Anthropic's models in the past to orchestrate AI-fueled attacks. In November, the company disclosed that a Chinese group used Claude to automate a hack on government and corporate targets. So this is very, very big. And this is why I wanted to lead off with this early tonight, because I don't think that any of us can really appreciate at the moment the dangers posed by something like this, by this Mythos, AI package. And I think it is highly, highly disturbing that, Scott Bessent and Jerome Powell had to call this meeting and got all the major bank CEOs in the room. That's how important they thought this was, to basically bring them all in and sit them down and say, listen, we might have a major, major problem here. And I'm sure that they were all told, like, hey, your IT departments, your cybersecurity experts, get them all cracking on this ASAP. Get them all cracking on this, because this is going to be a problem. Now, let's go back to these comments here by Anthropic's CEO. So the dangers of getting this wrong are obvious. So he starts with that. The dangers of getting this wrong are obvious. But if we get it right, there is a real opportunity to create a fundamentally more secure internet and world than we had before the advent of AI-powered cyber capabilities. So again, this is delusional on his part. I mean, to sit here and be like, so what exactly are the dangers of getting it wrong? Because it sounds to me like the dangers of getting it wrong means that this could destroy our entire economic system. Like that, that's pretty crazy. But he's looking at, but the upside here is that the real opportunity is that, we could, if I'm reading between the lines here, is that, hey, if the real opportunity here is that Anthropic could win the AI race and make a ton of money, and I could become stupid rich. That's the real opportunity here for them. But what does he mean about a fundamentally more secure internet? Like, what does that mean exactly? Does that mean more the reduction of fraud? Does that mean that we're all going to be living in a world that's more like China, where everybody is censored and on lockdown and can be canceled at any moment, and you get a hit to the social credit score? Like, what exactly does he mean there by fundamentally more secure internet? I would really like to know. I'm kind of fascinated by this. So I think that we should all be highly disturbed by this. And I'm beating a drum here that I've been talking about for months, and that is that the tech bros here need to be seriously reined in. This AI, this Wild West cowboy attitude around AI, where none of this makes any sense to me at the moment. Because on the one hand, you get this whole like, oh, well, we've got to win this because we're fighting with China, and it's us and China, and we have to win this race. We can't afford to let China beat us. Okay, I get that. But then it's like, but at the same time, we're going to sell all of our best chips to China too. We don't want the government to. So we have to win this race, and this is critical to everything. but we want to sell our best chips to China. We want to sell them all of our best gear here. We wouldn't want to handicap them for any reason, because why on earth would we want to do that? Because that makes no sense, right? And this whole thing just makes no sense. And the government, you've got states out there like Florida that are at least trying to put some guardrails around AI. And basically, and you've got the Trump administration there sitting there going, no, 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 no. No, we don't want no state. We don't want to let any state create their own AI law. We want this to be open. Let these guys run around. I just do not think that, I think that we are asking for a major problem if we continue to go down this road like this and allow this kind of stuff to happen. I just don't understand this like this. So they're like, oh, well, we're going to do this limited release here because we're worried about hackers, using it or whatever. It's like, well, okay, well, so I understand. So did the hackers already have it? Did they already have this? Already using it, and so you want to release it? Why? Like, why? Like, what? Like, if the hackers already have it, then what is the point of release? Like, I just, none of this makes any sense. None of this makes any sense. And it's crazy that basically you've got Bessent and Powell calling all of the top heads of all of the banks in the country to basically tell them, like, hey, look, this new model just rolled out. The hackers are going to use it. They're going to come after you. Probably Chinese hacker groups are going to come after you. This is not good. This is not good. So, we'll continue to keep an eye on this and see what happens with it. But I'm just highly disturbed by just the continuous updates we keep getting here. That, just again, the AI Wild West, man, the AI Wild West. They're just going to go out there. I mean, they're just going to, what, and then what are they, and I'm just curious, like, what's the government going to do? What are all these people going to do if one of these AI models here, like Mythos, if this comes out and just wrecks the economy, if it destroys the economy? I mean, what's the thing going to be? Oh, gosh, sorry, guys. Yeah, that was my bad. That was my bad. Sorry, I didn't mean to wreck everything. I didn't mean to wreck the whole stock market. I didn't mean to wreck the plumbing of the financial system. I didn't mean to wreck every bank in the country. Sorry, guys. Sorry about that. I didn't mean. My bad. My bad. I didn't mean to do that. Like, I mean, it's just nuts. But anyway, all right. I'll get off my soapbox on that. Okay, let's look at. We actually again had a little bit of optimism this week, like I said at the start. Which was good. So the war isn't over yet, but investors are already betting on back to normal. So that's good. Investors are celebrating early, even as an end to the war in Iran remains uncertain. Stocks are up for the week. The VIX is down, and prediction markets bettors put money on a return to normal by the end of June. So hey man, that's great news. So investors are buying the de-escalation story. The S&P 500 rose for 7 straight days. Only Friday, snapping a winning streak U.S. stocks hadn't otherwise seen all year. Geopolitical tensions have eased, with the U.S. and Iran agreeing to a tentative ceasefire and heading into weekend negotiations. And investors are apparently betting on a return to normal soon and celebrating early. The VIX, also known as Wall Street's Fear Index, closed below 20, signaling stability. The U.S. dollar, a haven asset, fell, and risk assets, including Bitcoin, are up. Prediction market bettors see the end of June as the likeliest timeline for lower crude oil prices and the U.S. ending military operations in Iran just over 2 months away. Risks, of course, remain. Among them, whether the Strait of Hormuz actually reopens and how the Federal Reserve, expected to transition to a new chair, will handle stubbornly high inflation. But for now, it seems many investors are comfortable with them. So, yep. So we'll see how this plays out, and then markets shift back toward potential Fed rate cut this year with Iran ceasefire in place. Again, good news. Traders are entertaining the possibility of an interest rate cut by the end of the year now that the U.S. and Iran have agreed to a ceasefire. Odds for a reduction jumped Wednesday morning, hitting 43% against 14% prior to the announcement. So traders are entertaining the possibility of an interest rate cut by the end of the year now that the U.S. and Iran have agreed to a ceasefire. Odds for a reduction jumped Wednesday morning, hitting about 43%, according to the CME Group's FedWatch tool, which uses 30-day Fed fund futures contracts to compute market expectations for moves by the Federal Reserve. Market pricing is implying a 3.5% rate in December for the first overnight borrowing benchmark, compared with the current effective level of 3.64%. Before the announcement, market implied odds for a rate cut were just 14%. Traders had expected the Fed would be hesitant to cut this year as the Iran conflict had sent energy prices skyrocketing, threatening the central bank's efforts to get inflation back to its 2% goal. Previous to that, markets had expected multiple reductions this year in an effort to shore up the plodding labor market. With at least a fragile piece in Iran, sentiment began tilting back toward a probability for a cut. So again, I think good news here that basically markets and everybody are seeing this shift back and hoping that things will get back to normal by, again, say the end of June. So that is very good. So this was a very interesting article that I thought was fantastic that I wanted to share with everyone. Let's see if I can make this a little bit bigger here. So this is in charts. The U.S. does not rely on the Strait of Hormuz oil, but impact still hits pump prices. So Asia's reliance on the Gulf oil through the vital waterway is battering the global market. So again, you can see here from this map, world reliance on Gulf energy, the percentage of each country's oil and gas imports coming from Gulf nations. So again, you can see here the U.S. Basically has about a 10% dependence on oil coming from Gulf nations. Again, not necessarily through the strait, as we'll see in a minute here. But again, let's compare this to some other countries here, right? So Mauritania in Africa, basically they get 76% of their oil here from the Gulf nations. India gets 50%. China gets 35%. Japan gets 57%. Pakistan gets 81%. So again, so the Asian countries over there, I mean, really, really dependent on the Gulf nations for their oil supply. So the Strait of Hormuz has been called the jugular vein for the world's oil supply. And as Operation Epic Fury proceeds, Iran continues to have a chokehold on the critical supply route. About 1/5 of the world's oil and gas is typically shipped through the narrow waterway connecting the Persian Gulf to the Arabian Sea. But Iran's attacks on commercial vessels have brought traffic through the strait to a virtual standstill since the start of the conflict on February 28th. In March, just 220 vessels transited the strait, according to data from maritime analytics platform Marine Traffic. Before the war, thousands of ships traversed the waterway each month. These actions have caused oil and gas prices to surge. Brent, a global benchmark for oil prices, has risen firmly above $100 per barrel overseas. Although the United States derives only a fraction of its oil from the region, global market forces have caused the average U.S. gas price to climb past $4 per gallon. U.S. President Donald Trump has threatened to launch strikes on Iran's oil wells, power plants, and critical oil infrastructure on Karg Island unless the strait is reopened. So we'll see. So they do have the ceasefire in place. So, and then some other interesting things here. So daily energy flow through the Strait of Hormuz, crude oil in millions of barrels. You can see here 21, 22, 23, 24, 25. About, again, handling it at 4.7 million barrels. Petroleum products here, about 6.1 million barrels. And then liquefied natural gas, billion cubic feet, 11.4 billion cubic feet. So again, very interesting. Just kind of give you an idea as to, what kind of tankers, what they're carrying and how much moves through the strait daily, which is a lot. So let's see here. The vast majority of crude oil and condensate, a natural gas byproduct, went to Asia. 91%, according to a U.S. Energy Information Administration analysis based on Vortexa tanker tracking data from the first half of 2025. Of those Asian nations, China and India absorbed about half of the crude moving through the strait, 37% and 14% respectively, followed by Japan and South Korea at 12% each. 16% went to other countries in Asia and Oceania. The United States and Europe remain marginal buyers, receiving just 3% and 4% respectively. So roughly 3/4 of crude oil traveled by tanker ship through the strait came from Saudi Arabia, 38%, Iraq, 22%, and the United Arab Emirates at 14%. Iran shipped just 11%. And you can see here crude oil exports transiting the Strait of Hormuz in 2025. Where did it originate from? Well, from Qatar, Kuwait, Iran, United Arab Emirates, Iraq, and Saudi Arabia. Go through the strait, and then its destination. Rest of the world 2%. The United States gets 3% of that. Europe gets 4%. Asia and Oceania 16%. Japan 12%. South Korea 12%. India 14%, and China 37%. So obviously, China and India, a lot of concern there on those part for both of those countries, as well as Japan, South Korea, and then other Asian and Oceania countries. But I think the point here that I was trying to show everybody is that the U.S. really doesn't depend all that much on this gas. We get a little bit of it, but not really that much. But at the same time, regardless of whether we get a lot of gas from the Gulf states or Gulf countries or not, it's still going to have an effect overall on oil prices because it's affecting the Strait of Hormuz and the countries that ship through it. Still has a major effect on the global economy, as we can see here. And then I just want to come down again, dependence on the Gulf nations. World's biggest energy buyers, total dollar value. So China. World's biggest energy buyers in 2024 went to China at 413 billion. United States coming in second at 233 billion. India coming in third at 180 billion. South Korea at 144 billion. Japan at 139 billion. And then the Netherlands coming in at 105 billion, and Singapore coming in next at 86 billion, followed by France, Germany, and the United Kingdom. But the three biggest buyers, no real shocker there, but China, the United States, and India, by far the three biggest buyers of the world's energy. And then Gulf sourced, again, we can see here, again, China at 35%, the United States at just 10% coming from all the Gulf, state or Gulf, I keep calling states, Gulf countries over there. But India at 50%, South Korea 55%, Japan at 57%. So again, this major shock causing inflationary waves, causing just a lot of problems for a lot of these countries around the world, no doubt. So again, I just really thought this was a great article. I really liked a lot of the charts here, and I think it really shows us what we're dealing with here, that Iran, despite the fact that they only generate about 11% of the total gas that's going through the strait, just the fact that they kind of gum it up for everybody else, that's where your real problem lies there. So, okay. So again, I wanted to point that out because I hope it adds a little bit more context and understanding to the situation. And hopefully, people get a better idea as to the flow of the oil market and why all of this causes oil prices to increase and go up. So now, what are some of the side effects here of this that we're dealing with? Well, as I've reported before, what was it, like aluminum, fertilizer, and helium, basically all facing shortages here because of this. But we had this one article here: the Iran war hikes fertilizer prices, squeezing farmers in planting season. So the conflict is coming at nearly the worst possible time. The spring planting season, economist Peter Early said. So much of the economic focus during the war in Iran has been on oil and gas supplies, but the interruption of an essential byproduct, fertilizer, may soon affect farmers as planting season begins. Fertilizer that farmers use in crop production is derived from natural gas or is processed using natural gas. About 30% of the world's fertilizer product passes through the Strait of Hormuz, which Iran has constricted, according to an April 1st report by the International Food Policy Research Institute. So 30%, that's a lot, man. That's a big chunk. The United Nations reports that the rate of shipping through the strait has fallen to fewer than 10 ships daily from an average of more than 100. Frequently, Over the past month, prices rose sharply for four of the eight major fertilizer types, according to DTN, an agriculture data analytics firm. Prices for urea were up about 35% over the past month, jumping from $677 per ton to $826 per ton in the past week alone. And hydrous ammonia and UAN 32 fertilizers were both up by 20% over the previous month. The world is now learning just how important the Strait of Hormuz is. Caleb Jasso, a policy expert at the Institute for Energy Research, told the Epoch Times, a great deal of trade of all kinds goes through that choke point, including a very sizable portion of the fertilizer market of the world. So yes, so again, definitely keeping our eye on this for sure. That is a fact. And then finally here, so Trump threatens tariffs of 50% on countries supplying military weapons to Iran. So U.S. President Donald Trump said any and all goods from countries found to be supplying Iran with weapons would be subject to sanctions. It comes after the U.S. and Iran agreed to a 2-week ceasefire. Affected countries would be subject to the levy immediately with no exclusions or exemptions, he added in a Truth Social post on Wednesday. So far, nothing has really come of this, but we'll keep an eye on it and see what ultimately happens with this. So that's kind of our update there on Iran. Now we're going to get into some of the other banking information here. So JP Morgan Chase. So Jamie Dimon, he put out his annual shareholder letter this week, and this is usually a big event every year that a lot of people look for. I would put this behind, Warren Buffett, obviously, used to put out his annual shareholders letter for Berkshire Hathaway. Always perhaps the biggest shareholder letter that anybody put out, year after year. But Jamie Dimon, being the CEO of the biggest, baddest bank in the world, obviously is going to, when he puts out his shareholders letter, that's going to garner a lot of attention. And the shareholders letter, they give it its own, it basically has its own website here. So jpmorganchase.com/ir/annual report 2025. And, you go down here and it has, the topics, specific issues facing our company, management learnings, managing in a time of increasing and complex risks, critical issues facing America and the world. And then in closing, and then Jamie stated, we are champions of banking's essential role in a community, its potential for bringing people together, for enabling companies and individuals to attain their goals, and for being a source of strength in difficult times. So, and again, I'm not going to get into this whole thing. I just wanted to show everything to everybody on this. I'm actually doing an episode this week where I'm going to cover this, the whole letter, and get into all these different sections and everything and break this down to people. Because again, I think there's a lot of very interesting tidbits for this. But now, just to give everybody an overview of the letter, though, we're going to go to this Wall Street Journal article here and basically 5 risks Jamie Dimon is worried about in 2026. So the JP Morgan's chief executive highlighted a range of scenarios in his annual letter to shareholders that could have a decisive impact on world affairs. So let's take a look at it. So obviously inflation. So since the U.S. and Israel began bombing Iran at the end of February, oil prices have skyrocketed as Tehran has halted passage of most ships through the Strait of Hormuz. Dimon said there is a risk of more oil and commodity price shocks in the months ahead, which could lead to a prolonged inflation and higher interest rates. The skunk at the party, and it could happen in 2026, would be inflation slowly going up, Dimon wrote. This alone could cause interest rates to rise and asset prices to drop. Still, Dimon said the outcome of conflicts between the world's greatest powers is more important than the financial impacts that they may bring. And then we'd get into intensifying competition. Dimon also has reason to worry about rivals chipping away at JP Morgan's business. In addition to stepped up competition from other big banks and regional lenders, he noted JP Morgan faced a growing set of non-traditional rivals in payments and digital banking. And he noted a whole new set of competitors is emerging based on blockchain, including stablecoins. I'm not going to mention all their names, but you can imagine that we study and track over 100 of them, he wrote. And of course, I've talked about that a lot as far as just all the new bank charters that are coming in, the de novos that have popped up here in the last few months, and just how a lot of those companies are very different than your like traditional banks, right? You've got digital players in there, you got neobanks, you got crypto companies, you got a whole bunch of different players in there. I literally just did an episode on Friday, if I can look to that for a second. So I did the episode I just had that came out yesterday was called "A New Wave of Foreign Banks Adds Another Competitive Dynamic," and I'll talk about that in a few minutes when I get into the episodes that I put out this week. But I tried to talk about the different banks that are trying to garner into the U.S. market. I also pointed out a certain bank, was it Monzo? They basically had tried to enter the U.S. market, but basically didn't really have a good go of it, and they got a full banking license over in Europe. So they were like, "All right, we're staying to Europe. We're bailing on the U.S. market, and we're just going to go deal with Europe." So again, I'll have a little bit more information on that, but definitely a very important topic at the moment. This idea of intensifying competition. Then we get into Americans' loss of trust in the government. Now, I don't think this is anything new. This has been basically on a downhill trajectory for the last 30 years. Diamond argued that Americans are losing trust in government because of pervasive amounts of wasteful spending and high taxes in many cities and states. He also noted that people are heading for the exits from those places, arguing that no city has a divine right to success. He also worried that economic growth isn't being equally spread, keeping the American dream out of reach for millions of people. Diamond proposed a number of regulatory fixes that would make it easier to build affordable housing and start businesses, all of which would help the economy grow. Growth is part of the solution to almost all of our problems. Then we get into artificial intelligence. So JP Morgan has been embracing AI, and Diamond has acknowledged the technology will influence how the bank thinks about staffing needs among its 300,000 plus employees. AI will affect virtually every function, application, and process in the company, Diamond wrote. It will definitely eliminate some jobs while it enhances others. A big concern Diamond highlighted is how the government should help prepare society for the workforce transformation AI is poised to bring. There is a possibility that AI deployment will move faster than workforce adaptation to new job creation, he said. Business and government can do many things to properly incent retraining, income assistance, reskilling, early retirement, and relocation for those whose jobs might be adversely impacted by AI. So, yes, very interesting comments from Jamie on the AI front. And then finally, weak allies. Diamond also expressed worries about the future of the European Union. He has long said he's worried about the fate of the Western world, and he put plenty of blame on Europe's inability to reform and present a united front against world powers like China and Russia. Europe is entering a decisive decade, and it is unable to act, he said. He cited a range of problems beleaguering the EU, including international trade barriers and expensive social welfare programs, but he praised how EU countries have boosted spending on their militaries and said the continent still has time to turn things around. While America and Europe do have real differences, we believe that a stronger Europe militarily and economically is in America's self-interest, he said. I will just say this. I think that there is a high probability that Europe is going to enter. I think the next 10 years in Europe are going to be a wild, wild time. I think that the whole concept of the European Union is in a lot of danger. I think there's a very good chance that the European Union could collapse in the next 10 years as just all of these problems in Europe come home to roost. I think there's a possibility that civil war may be on the horizon in Europe because of a lot of their problems, but we'll see what happens. But those are the five main things that Jamie Dimon is put out as his big concerns. Basically, weak allies, artificial intelligence, America's loss of trust in the government, intensifying competition, and inflation. So given what I just talked about the big meeting in DC this week on AI, I would put AI right this minute as probably the number one worry. As of this moment, that is the number one concern. It was not my concern. I would say probably inflation, interest rates, intensifying competition. I would put those as my big concerns for the U.S. economy at prior to this week. But after this week, AI is my number one concern, hands down. That is my primary concern, because it's not being managed properly. I don't think I'll say it that way. So all right, let's get into some economic numbers here for the next few minutes. So, consumer sentiment hits record low. Inflation fears rise amid the Iran war. So, consumer sentiment plunged to a record low in April as fears mounted over rising energy prices and the broader impact of the Iran war. According to a University of Michigan survey, the drop in sentiment coincided with a sharp spike in inflation expectations, with respondents seeing prices up 4.8% in a year from now, a full percentage point rise from the March reading. So consumer confidence plunged to a record low in April as fears mounted over rising energy prices and the broader impact of the Iran war. The university's headline index of consumer sentiment tumbled to 47.6%, down 10.7% from the March survey to its lowest on record. Current conditions and expectations indexes also saw double-digit monthly declines. So the drop in sentiment coincided with a sharp spike in inflation expectations, with respondents seeing prices up 4.8% in a year from now, a full percentage point rise for the March readings to its highest since August of 2025. The one-year outlook in April 2025 was 6.5%, following President Donald Trump's Liberation Day tariff announcement. Now, obviously, we knew that didn't happen. That didn't happen at all. It didn't come anywhere near that. So, I don't know. I think this inflation spike up to 4.8%, I think that's a little ridiculous. I don't see anything like, I mean, even at where I think even worst case scenario, you get into a much deeper conflict there with Iran. Could inflation spike up to 4%? Yeah, I think that's a possibility. 4.8% or even higher than that. I don't really see that. I think things would have to go catastrophically wrong, I think, to get there to that point. I'll just put it that way. So all right, and then let's get into some of the inflation data. So consumer prices rose 3.3% in March as energy prices spiked due to the Iran conflict. So consumer price indexes increased a seasonally adjusted 0.9% in March, putting the annual inflation rate at 3.3%. However, core prices rose much less, to just 0.2% for the month and 2.6% from a year ago, both 0.1 percentage point below forecast, indicating that underlying inflation was contained. The Iran conflict was the story for the monthly inflation reading, as gasoline soared 21.2%, accounting for nearly 3/4 of the headline price increase, according to the BLS. So consumer prices spiked in March as the Iran war sent energy costs soaring and took the Federal Reserve further from its inflation target. The consumer price index, like we said, increased. But as we see here, so U.S. Consumer Price Index here, January through March 2026, we can see here all items basically up 3.3% year over year, but less food and energy, although i.e. the core price still at 2.6%. So pretty sizable difference there between the overall number and the core number. But obviously, the core number remaining somewhat contained, but the overall number increasing. And as we shall see here, when we go to, here's the inflation breakdown for March 2026 in one chart, and we scroll down here, we can see here that basically all of this was, the main bulk of this was all in energy prices. Obviously, gasoline shooting up 18.9%, energy overall up 12.5%, but electricity up 4.6%, and piped gas service up 6.4%. So major price increases in energy. But then also food, we saw a good jump here, I think, in some of the food here, fruits and vegetables up 4%. Non-alcoholic beverages and materials, 4.7%. Other food at home, 2.9%. Food away from home, in other words, eating out, up 3.8%. So again, just big spikes in a lot of this stuff. Just food at home, generally up about 1.9%. Cereals and baked products up 2.1%. So again, this is where we're seeing. And then down here, obviously airfares again, going up 14.9%, but obviously that's all because of the increase in gas and increase in energy prices. Tobacco and smoking products up 7.4%, alcoholic beverages up 1.7%, apparel up 3.4%. So again, it's the energy. The energy right here is driving all this spike, and that's why I think a lot of the markets were positive. Like when we go back to here, the war isn't over yet, but investors are already back to normal. With the market shift back toward a potential rate cut, like the reason why we saw this positivity this week is because a lot of this was just centered in energy. And if this conflict with Iran really settles down, if they reach a peace agreement, then all these energy prices will go back as a lot of the prediction betting markets, right? They are betting markets, but prediction markets basically all seeing this hopefully returning to normal by the end of June. So that's what you're seeing here. Let's all hope. Let's all keep our fingers crossed. Let's say some prayers, and let's hope that this all gets back to the right a better place. And then, so that was the CPI. Now let's take a look at the other inflation index, the PCE. So inflation held sticky at 3% as the U.S. headed into war with Iran, key Fed gauge shows. So the core personal consumption expenditures price index rose a seasonally adjusted 3% in February. The Commerce Department reported the all items headline inflation measure increased 2.8%. In addition to the inflation readings, the report also showed consumer spending up 0.5% on the month, while personal income fell 0.1%. So core inflation held above the Federal Reserve's target before the recent surge in energy prices, according to a key gauge released Thursday that offers the central bank a snapshot of conditions leading into the Iran war. The core personal consumption expenditures price index, which excludes food and energy, rose a seasonally adjusted 3% in February. The Consumer Department reported the all items headline inflation measures increased 2.8%. So both readings were in line with the Dow Jones consensus. The core annual inflation rate was 0.1 percentage point lower than in January, while headline was unchanged. On a monthly basis, both core and headline prices rose 0.4%, also meeting forecasts. The Fed uses the PCE price index as its primary yardstick and forecasting tool for inflation. The Fed, which targets 2% inflation, sees core as a better indicator of long-term trends. In addition to the inflation readings, the report also showed consumer spending up 0.5% on the month, while personal income fell 0.1%. Economists had expected spending to rise 0.6%, with income up 0.4%. So separately, the Commerce Department reported that economic growth was even slower than previously reported for the fourth quarter of 2025. The gross domestic product, a measure of all goods and services produced, rose just 0.5% on a seasonally adjusted annualized rate, down from the prior reading of 0.7% and the initial estimate of 1.4%. The full year growth rate held at 2.1%. The department said the downward revision came primarily to lower investment than previously indicated. A key metric for demand, called real final sales to private domestic purchasers, was cut to a 1.8% growth rate, down 0.6 percentage points from the first estimate. So again, we had the government shutdown in the fourth quarter of last year. That's what really killed, the GDP numbers, and we'll have to see if these GDP numbers bounce back at all here in the first quarter. We should be getting some better GDP readings here in the next couple weeks as we continue to get deeper into April. But again, we got that final GDP number, and it was just not a good number there for the fourth quarter of last year. But you saw firsthand what impact that long government shutdown had on the overall GDP numbers. If we don't have that government shutdown, GDP number is probably fantastic. I mean, they were looking at over 4% growth for the fourth quarter last year. So if we had gotten that number, the GDP for 2025 looks amazing. Looks like a fantastic number. So, but again, I think the good takeaway here is that inflation, again, it held sticky at 3%. Like we're kind of knocking up against that 2.8, 2.9%. It's at 3%. But the core number held at, just below that at 2.8%. And then also on the CPI number, we got the core number also holding at 2.6%. So I think the good news here is that while we have seen this little spike in inflation, it has not been devastating. It has not been horrible. And if we do get a peace deal again with Iran and the Strait of Hormuz begins to open up a little bit, all of this will go back to normal, or we'll start trending back towards what we were seeing last year, at the beginning of this year. Again, we can all go back to that relatively quickly within a 3-month time span, if we get some kind of peace agreement here. I know that's a big if, but we shall see there. So we got CPI, PCE, and we got the GDP numbers. But now let's talk about the Fed for a couple of minutes here. So at the beginning of last week, it was reported that basically Kevin Warsh, that they were going to finally get a vote on his confirmation, at least to get it out of committee. Then on that, I think that was on like Monday or Tuesday that was reported. And then on Thursday, we got this. Kevin Warsh Fed chair confirmation plan hits a snag as nomination hearing is delayed. So a Senate hearing for Federal Reserve Chairman nominee Kevin Warsh won't be held next week as planned. The committee set to hear Warsh's nomination hasn't received the paperwork that he needs with enough time to schedule the hearing. People familiar with the matter told CNBC that oh, sorry, I got something in my throat there. Yeah, I think that's a little, as the kids say today, it's a little sus. That's a little sus. The Trump administration is hoping to get Warsh to replace Chairman Jeremy Powell by mid-May, but that timeline looks challenging. Yeah, I think there's a 0% chance of that happening. Senator Tom Tillis, the Republican from North Carolina, is refusing to vote for any Fed nominee until the Department of Justice drops a criminal probe into Powell. So an expected Senate hearing on the nomination of Kevin Warsh has been delayed. Warsh had been set to appear before the Senate Banking Committee on April 16th. That won't happen, but the hearing is still expected soon, the person said, requesting anonymity as the details have not been made public by the committee. The committee's rules require that it is given a week's notice before the hearing is held, and the panel first needs to collect paperwork from the nominee, including financial disclosures. The Banking Committee has yet to receive Warsh's paperwork, according to 3 people familiar with the Senate process. The committee has not formally noticed the hearing. The deadline for doing so was Thursday. Punchbowl earlier reported to delay to Warsh's hearings. Yeah, I think this is all nonsense. I really do. I think this is Jerome Powell and Tom Tillis working in the background just to gum up the works. As that is the way I'm reading this at the moment. So then we got this. Judge Jeanine Pirro's Powell probe faces a difficult road to appeal, former prosecutors say. So a criminal investigation into Federal Reserve Chair Jerome Powell is holding up the confirmation of Kevin Warsh, the nominee to replace Powell. A federal judge recently quashed U.S. Attorney Jeanine Pirro's subpoenas to the Fed, calling the investigation's future into question. Pirro has said she will appeal, but former federal prosecutors with appeals experience say her chances of success are slim and that the matter could blow back on her legally. So, and then we get this here. Judge won't reconsider decision on DOJ's Powell probe. The government's arguments do not come close to convincing the court that a different outcome is warranted, said Judge James Boasberg, said a U.S. Attorney's Office, though a U.S. Attorney's Office said it would appeal. So a federal judge on Friday denied the Justice Department's motion to reconsider his quashing of subpoenas related to an investigation of Federal Reserve Chairman Jeremy Powell. The standard for reconsideration is a demanding one. The movant must show that there has been an intervening change in controlling law, new evidence, or a need to correct clear error on or prevent manifest injustice. Judge James Boasberg of the U.S. District Court for the District of Columbia wrote Friday. Boasberg's last month concluded that the subpoena's dominant, if not sole purpose, is to harass and pressure Powell into either lowering interest rates or resigning to make way for a successor who would. Now, Justice James Boasberg is a very highly questionable character who is a highly politicized partisan here in these proceedings. And again, it just amazes to me how this guy continues to find himself onto the way of all of these major cases. It's a miracle. It's a miracle. This guy just constantly shows up time and time again. It's like, how about that? When he showed up in this case originally, I didn't talk about it in the live stream, but I thought to myself, of course it was him. Of course this guy showed up. This guy just shows up everywhere. And like, it seems he shows up for anytime a major ruling is needed, he is right there to provide. He does not disappoint. But look, I think that being said, this guy, look, I'll put it this way. The swamp has shown up to protect Jeremy Powell, to protect the Fed, as it always does. And, you got to protect your moneymaker, right? Got to protect the moneymaker. And, I think you got to look at this point, big picture. What is, in other words, I would be asking the Trump administration, guys, what is the more important thing here? Do you want to continue to harass Jeremy Powell? And look, and I think that there is something here. I think that whatever's going on with these renovations, the fact that these costs ballooned to $2.5 billion, I think is insane. When you consider the tight size of office buildings that we're talking about, when you talk about just the palatial appointments of what was going on here with these Fed buildings, I think there's a lot there that needs to be talked about and needs to be fleshed out, because there's obviously some concerning things there. But I would also say that I think at this point, the far more important thing is to get Kevin Warsh in. And again, I don't think this is going anywhere. And if Judge Jeanine wants to continue to fight this and continue to go down, I ultimately, I think the problem here is, I think this doesn't go anywhere. And I think as long as this is out here, this is gumming up the works, and it's going to continue to delay the nomination of Kevin Warsh. So, I mean, I would be an advocate at this point to basically just say, dude, just let this thing die. Let it die. Let it go away. Drop this thing. And then, tell what's his name? Tom Tillis. Tell Tom Tillis to shut up and get in there and put the vote through and get Kevin Warsh nominated, so that hopefully we can get rid of Jerome Powell and just get him gone, get him out of there, and hopefully let Kevin Warsh go in there and hopefully do a better job. That is basically what I would say on this at this point. So, because I just think ultimately, like I said, while I do think that there is something there, and something that, again, will just continue to stain Jeremy Powell in the years forward as he tries to create the narrative around his legacy as chairman of the Fed. So I think this, again, like I said, it's just another stain on his time there at the Fed, and I think this is something that will come back to bite him in the years ahead. But for right now, again, it's not doing anything. It's not helping. It's not doing anything. So I think they should just let it go and be done with it, and just focus on getting Kevin Warsh nominated, because that big picture is the far more important thing here at the moment. So, all right, we talked about that. Okay, I'm going to get into the private credit stuff in a moment, and then I got a whole bunch. I got a bunch of other articles there, and then I got a bunch of banking news to kind of take us through to the end. But before we get there, what I really want to do is I want to focus in on this is the time of the evening where I like to switch gears. I like to give everybody the economic indicators that are going to come out this week. I like to talk about the episodes that I put out this week, and I also like to give everybody some banking news. So let's go into the economic indicators here, shall we? So on Monday, April 13th, we get existing home sales. On Tuesday, April 14th, we get the IEA monthly report, the ADP employment change weekly, PPI for March, the API weekly crude oil stock. On Wednesday, April 15th, we get export price index, the import price index, the New York Empire State Manufacturing Index, and we get the beige book at 2 p.m. On Thursday, April 16th, we get initial jobless claims, continuing jobless claims, Philadelphia Fed Manufacturing Index, and industrial production for March. And then finally, on Friday, April 17th, we get the U.S. Baker Hughes oil rig count. So again, not a ton of economic data this week. Obviously, the PPI will be interesting because that will kind of complete our inflation picture after getting the CPI and the PCE this week. We already got some GDP numbers, so we get a little bit of labor market numbers with initial jobless claims and continuing jobless claims, some manufacturing information. It'll be interesting, as far as manufacturing goes, we get the New York State Manufacturing Index and then the Philly Fed Manufacturing Index. So the manufacturing has been going really good since the start of the year, and we've seen 3 straight months of increase. So I will be curious here if we see a 4th straight month of growth and increase there, which would be really nice. That would be some really positive news there. But okay, but let's get into some bank news here, as I had a lot of bank news this week. So wholesale inventories rose in February. Consumer spending rises despite a dip in incomes, which I talked about a few minutes ago. So the CSBS survey on community banks. So community bankers remain optimistic about the future, though their outlook on the impact of monetary policies and regulation is waning, according to the Conference of State Bank Supervisors' latest quarterly poll. So again, very interesting there. So again, community bankers remain optimistic about the future, but they're worried. They're a little worried there. So okay, mortgage applications declined. I had mentioned that earlier. The SEC names a new director of enforcement division. So the Securities and Exchange Commission announced that David Woodcock had been appointed director of its division of enforcement effective May 4th. FOMC members discuss inflation impact of Middle East conflict in the minutes. So participants at last month's Federal Open Markets Committee meeting debated the economic and monetary policy implications of development in the Middle East, according to meeting minutes. Most participants had a protracted conflict could lead to a further softening in labor market conditions, which would warrant additional rate cuts. Meanwhile, many participants pointed to the risk of inflation remaining elevated for longer than expected amid a persistent increase in oil prices, which could call for rate increases. But most participants reiterated that it was too early to know how developments would affect the U.S. economy and said continued monitoring is needed. So durable goods orders declined in February. Consumer credit rises 2.2% in February. Agencies warn Iran is targeting industrial systems. So the FBI, Cybersecurity and Infrastructure Security Agency, and other agencies warn that Iran-affiliated threat actors are targeting internet-facing operations, technology devices used by local municipalities, water and wastewater systems, and energy sectors. Services sector expands at the slowest pace in March. Zelle expands MDI access program. So the Zelle network recently announced the second year of its, its Minority Depository Institution Access Program. Zelle said it is partnering with Jack Henry to expand access to the program to more MDIs. So that's good news. IRS partnerships eligible for online platforms. So the IRS announced the expansion of its business tax account online self-service platform available to partnerships, federal, state, local, and Indian tribal governments and tax-exempt organizations. So the newly eligible entities join sole proprietors, S corporations, and C corporations in having access to the platform. So the business tax account is a secure, centralized platform that allows eligible users to manage their federal tax responsibilities online. So that's pretty interesting. Let's see here. Employers added 178,000 jobs in March. Trump's 2027 budget calls for CDFI fund cuts. Yeah, I've got an article on that. I'll talk about that a little bit more towards the end. FDIC and the OCC finalize ICBA-backed rule barring agency use of reputational risk. We'll get into that also a little bit later. Let's see here. FBI, crypto, AI lead cybercrime complaints. So the FBI released its 2025 Internet Crime Report, and that shows that cyber-enabled crimes defrauded Americans of nearly $21 billion, with cryptocurrency and artificial intelligence-related complaints among the costliest. The Bureau's Internet Crime Complaint Center said it received more than 1 million complaints last year, up from 859,000 in 2024, and included 453,000 cyber-enabled fraud complaints. Americans who submitted complaints involving cryptocurrency reported the highest losses, with 181,000 complaints totaling more than $11 billion, 54% of the annual total. Crypto investment scam losses climbed 25% to reach more than 7.2 billion, while nearly 14,000 complaints involving crypto ATMs, up 48% over 2024. So that is really interesting. ICBA and state groups called for the FDIC to reconsider the Edward Jones ILCA. So ICBA issued a national news release on its recent letter with 38 state banking associations urging the FDIC to reconsider Edward Jones' deposit insurance application to form an industrial loan company. ICBA and state groups also object to Kraken master accounts. So ICBA and 42 state banking associations objected to the Federal Reserve Bank of Kansas City's approval of a master account for Kraken Financial. So the Kansas City Federal Reserve last month approved a limited purpose master account for Kraken, making the uninsured Wyoming Special Purpose Depository Institution the first crypto company to receive any form of a master account. So, and this is called the unfinished prototype. So the announcement came while the Fed is still considering a limited purpose payment account prototype, also known as a skinny master account for institutions that operate outside the traditional banking regulatory framework. So again, we will keep an eye on that one. So Treasury releases guidance on opportunity zones. Fed proposes allowing intermediaries for FedNow funds transfers. We'll talk about that a little bit more later. CFPB consumer complaints continued to rise in 2025. So the Consumer Financial Protection Bureau said consumer complaints to the Bureau reached a new high in 2025. It received more than 6.6 million complaints last year, more than double the 2024 total. It sent 90% of complaints to companies for review and response, referring 3% to other regulatory agencies. It found 7% to not be actionable. So BNY Robinhood to partner on implementing Trump accounts. We'll talk about that also a little bit later. ICBA urges relief from CFPB credit card survey. So ICBA urged the Consumer Financial Protection Bureau to reduce the regulatory burden on community banks imposed by its terms of credit card plans survey. So, all right, that, and then some other big things that I will be. This is way too much. I couldn't possibly cover all this stuff in the live stream, but we had a lot of crypto-related reports and things that came out this week. So the White House first had a report downplaying the risks of the stablecoin impact on banks. So the White House Council of Economic Advisors issued a report downplaying banking industry concerns with the impact of payment stablecoins on bank deposits and lending. So arguing that stablecoins function as a safe asset and other distinct benefits to holders relative to bank deposits, the White House report says prohibiting payment stablecoin yield would lead to increased conventional deposits, but would have only a marginal impact on lending. The results conflict with analyses from ICBA and other organizations that show a greater potential negative economic impact from stablecoins, especially when allowing yield-bearing payment stablecoins. So then we have Treasury proposes Genius Act AML, sanctions rule for stablecoin issuers. So the Treasury Department's Financial Crimes Enforcement Network, also known as FinCEN, and the Office of Foreign Asset Controls, also known as the OFAC, issued a joint proposed rule to implement the Genius Act's anti-money laundering and sanctions compliance program requirements. So the Genius Act directs the Treasury to issue regulations that would treat permitted payment stablecoin issuers as financial institutions for purposes of the Bank Secrecy Act, requiring them to meet anti-money laundering obligations. The law also directs Treasury to develop a sanctions compliance regime for issuers. Okay, and then Treasury announces cybersecurity info sharing initiative for digital asset industry. So the Treasury Department's Office of Cybersecurity and Critical Infrastructure Protection announced a new initiative designed to strengthen cybersecurity across the digital asset industry. So under the initiative, eligible U.S. digital asset firms and industry organizations that meet Treasury's criteria will be able to receive at no cost the same actionable cybersecurity information Treasury regularly shares with traditional U.S. financial institutions. So again, interesting. And then finally, the FDIC proposes Genius Act framework for stablecoin issuers. The FDIC released a proposed rule to establish a potential framework for FDIC-supervised payment stablecoin issuers under the Genius Act. The proposed rule would establish requirements for FDIC-supervised permitted payment stablecoin issuers and insured depository institutions that provide certain payment stablecoin-related custodial and safekeeping services, implement requirements related to reserve assets, redemption, capital, and risk management standards, address the applicability of pass-through insurance to deposits held as reserves backing payment stablecoins, and clarify the tokenized deposits that satisfy the statutory definition of deposit would be treated no differently under the FDIC Act than any other types of deposits. So very, very interesting update. I will be I have all those reports handy. I'm sure I will be doing individual episodes on those reports because there's a lot there to break down and look at and analyze and report back to everyone. So again, keep an eye out for that over the next couple of weeks. I'll be coming back with that. So now let me just talk very quickly about the 6 episodes that I put out this week. So first up, last Sunday, I did a BND Strategy Room bonus episode, which was called Blue Owl, Cliffwater, and Others in Trouble as Redemptions Explode. So that was just basically a short clip from last week's live stream, but it was my entire discussion on private credit for last week. So the conversation around private credit continues as redemptions explode in the last few weeks. The problem has turned extreme at Blue Owl, where they have 2 funds that are currently under pressure. This clip also looks at is another crisis on the horizon, banks' overall exposure to private credit, how loans to private credit have been the #1 loan category for banks over the last 5 years, private credit's retreat from commercial real estate loans, private credit's exposure to the software industry, Fitch downgrades non-bank direct lenders, also known as BDCs. Cliffwater is under extreme pressure. Wealthy investors are heading for the exit, and banks stand to lose a major stream of income if private credit market dries up. Private credit is really throwing off 2008 vibes. And then finally, Labor Department proposes 401k alternative asset rule. Is that really a good idea right now? I think that is a very legitimate question. So that was part of that was my private credit conversation in last week's live stream. I'll have more private credit update in just a minute. But then I started out my 5 episodes for the week on Monday. So I started out with a review of ICBA advocacy in action for the second quarter of 2026. So, and this episode basically looks at the 2-page PDF that provides a short summary of all the major regulatory issues in the banking industry. The topics include digital assets regulatory frameworks, House advances community bank regulatory relief bills, the Farm Bill and Aid, executive order to create mortgage rule relief, challenges to the 1071 rule and statute, deposit insurance reform, and the 1033 rule, also known as open banking, master account access, and OCC trust charter, and GSEs. So I really love that report because it basically gives you a complete rundown of all the major hot button regulatory items in the banking industry in a very simple, straightforward 2-page PDF document. So that's why I love ICBA does a really good job with that. I love covering that because basically in 10 minutes, I could give everybody the complete regulatory overview of everything that's going on. You could get caught up, bang, just like that, and you'll impress everybody, all the parties, knowing all the hot regulatory issues. Of course, right? Of course. Okay. Then on Tuesday, I did review of OCC report on bank trading and derivative activities for the fourth quarter of 2025. Now, I love to look at this report. This is a quarterly report that gets put out by the OCC, which basically covers, bank trading revenue, how are banks, how are basically not the basically the investment banking divisions of all the major banks doing. And then it is always, always critical to look at the derivatives activities. Where are derivatives out? It's really important to understand the makeup of derivatives. There's a number of different types of derivatives, the vast majority of which are basically derived into interest type contracts. So again, it's just very important to understand at least the basics around derivatives and how derivatives work and just the overall size. Derivatives are just a massive, massive market. And if anyone wants to check it out, Chatham Financial is a great company located here in Pennsylvania. And I had the honor of I did 3 interviews. Bob Newman, very good friend of mine who is actually retired. And then Jason Lang, another who took his place, another great guy over there at Chatham. I did a couple of really great interviews with them talking about derivatives, going over a basic derivative, kind of what they call vanilla derivatives contract. And they're just talking about how you can use derivatives as hedging strategies of both not only loans but in deposits for banks, and really help banks to better manage their balance sheets and interest rate risks and things of that nature. So again, if you want to go check out those interviews, go check them out. Highly watched interviews. People really love them. So good thing to check out there. Then on Wednesday, I did review of GAO and OIG reports on workforce reductions for the SEC and the FDIC. Now, I really wanted to point out here how the budgets and the workforce, just the general employment numbers of both the FDIC and the SEC have been really reduced in the last couple of years. And I think it's just important to note that, to see like what's going on there with the reductions. And the big concern there is the brain drain, right? You've got a lot of professionals with a lot of years of industry experience, going out the door. The vast majority of these people weren't laid off. It was actually people that just took the early retirement package that was offered to them. But so I think there is both good and bad here. I think it's actually good that these agencies were reduced in the workforce. I think you could hopefully get them working leaner and meaner, which I think is great. But yeah, I mean, there is some concern about brain drain, right? Like there is some concern that you kind of lose that great just informational knowledge that a lot of these employees have. So that is a concern, but definitely check that episode out, because I think that part of the reason why I wanted to do that episode was because I think that will be a setup for other things that may yet come over the next year or two. So not that I have any kind of insider information or anything like that. It's just, call it a hunch, call it a gut feel, that there might be some more happening there with the SEC and the FDIC. But like I said, that episode could prove important down the road, but we'll keep an eye on it. Then on Thursday, I did how to prevent tech buyers' remorse. So banks can experience buyer's remorse when they purchase costly software to upgrade their technology stack. This experience can be extremely painful, as most community banks have small technology budgets to work with. Spending the bank's budget on new technology that does not work out will most likely end up as money that cannot be recovered. This episode considers reasons why organizations regret tech purchases and offer strategies to use when purchasing new technology. So again, I think this was a very critical topic, because technology is such a big thing, and I cover all kinds of surveys year in and year out, basically saying that technology and technology advancements, tech spending, I mean, these are top of the list every year for banks, and just the things that they consider when they're doing their strategic planning, what they're going to spend their money on. And technology is always right there. And so I think this is a very important episode, because as I have talked before in the past, what most people don't realize is that the vast majority of your IT projects do not work out as intended. They take too long to implement. They end up costing way more than you thought. The training takes longer. The implementation takes longer. You get all kinds of bugs on the back end that you have to work out. And by the time you get to the point where that thing is really up and running, it's been implemented. The employees are all trained up on it. They worked out the bugs. Everything's going right. Again, the sunk cost in that thing could be tremendous, so and that's what happens a lot of times, and that's what makes a lot of bankers out there hesitant to pull the trigger on some of these big ticket items. That's why when a lot of fintechs come in and they promise everybody the moon, the sun, and the stars, and basically a lot of bankers kind of roll their eyes and like, oh, okay, yeah, this is going to solve all my problems, whatever. In reality, it's going to cost me a tremendous amount of money. It's going to cause me a bunch of agita. It's probably going to give me an ulcer, and before this thing is successfully implemented. So again, I think that this concept of tech buyer's remorse is a big one for banks out there. And I think if there are any fintechs out there watching this live stream or pay attention to my channel, anybody that works in the fintech space, this would be a really important episode, I think, for you to key in on and pay a special attention to, because this also plays into a lot of the pushback that you would get, right? Like when you're in there trying to sell something to banks, you're gonna get a lot of pushback like this, and this is going to be one of those things where you can look at and you can try to alleviate some of those fears by addressing this up front. So just a thought. So, all right. And then finally on Friday, I did an episode called A New Wave of Foreign Banks Adds Another Competitive Dynamic. So foreign banks are seeking to gain access to the U.S. banking market. This is nothing new, but what is new is the type of bank that wants access. So the new competition tends to be fintechs and neobanks with a digital-first approach. Some examples include Oak North Bank, Revolut, and Nubank, and that's spelled Nubank, Nubank. These banks tend to be built around a customer-friendly digital interface. Young customers are seeking a digital-first approach right now. However, while the U.S. market can offer immense opportunities, it also presents difficult hurdles to overcome. And not all foreign banks have found success entering the U.S. market. Enter Monzo, a UK-based fintech, recently decided to give up on its push into U.S. banking. Monzo decided to shift their focus back to Europe, where it gained a banking license in December. So again, I thought that this was really interesting just to point this out, and it kind of goes hand in hand with what I was talking a few minutes ago about Jamie Dimon in his annual shareholders letter, talking about increased new competition. There's no doubt, he said that they were tracking over 100 firms, and there's no doubt that Oak North, Revolut, and Nubank, all three of those are on his list. There's no doubt about it. And looking at some of these new foreign players that are trying to come in, again, they're approaching it from, we're not going to have bank branches. We're going to be fully digital. And this is what the younger generation is really looking for right now, which is very true. So, but like I said, Monzo tried to do the same kind of thing, and it did not work out for them because there was so much competition already in the U.S. market. So, but believe it or not, people still like to deal with their brick and mortar banks. There is a huge psychological component to it. And I think that, part of the thing is with younger individuals is that they love the tech, right? They love the streamlined, make it easy, make it quick, make it painless. They love all that. But they also don't have a ton of assets yet. If you're in your 20s and your 30s, for most people at that age group, you haven't really had a chance to accumulate a big chunk of assets yet. It's not really until your 40s, 50s, and 60s that you really begin to accumulate a lot of net worth. And so the thought being here from these new competitors is that, yeah, we'll grab them while they're young. And then as they build net worth and everything over time, they will have a lot more money and thus assets held here with us instead of at a traditional bank. And there is a lot of that on the horizon. But the other thing I would say is that, a lot of these younger people, they have not lived through major crisis yet. They haven't lived through a dot-com bubble bursting. They haven't lived through a great recession. They haven't lived through stock market implosions. They did live through the pandemic, but a lot of them were young, probably still in school during the pandemic. They weren't, out there, with a job, living on their own, supporting themselves. They weren't into that stage of their life yet. So I think that older people that are in their 40s, 50s, 60s, 70s, that have been around the block and have been through a number of these type of situations, they're not so fast to jump on board the digital train. They like a physical presence, man. They want to know that I could drive down the street and walk into my bank and somebody there is going to be accountable to me. Like they like that, So again, just putting that out there. So, the psychological component of the physical bank branch is still a very powerful attractor. So I just put it that way. So, okay, those were the 6 episodes that I had out for this week. So let's jump back into some of the articles here. Let's get back to the private credit stuff here for a moment, shall we? Okay, now what I'm going to do is I'm going to go over this article with everybody here, but then I have a bunch of private credit news that I want to share with everybody, a bunch of little tidbits here. So, but here is this. This I thought was perhaps the most interesting thing of the week on the private credit front. And that is insurers $1 trillion with a T, $1 trillion buildup in private credit is leaving regulators in the dust. Treasury Department officials plan to meet with states about their market risk. So the Treasury Department wants to talk to state insurance commissioners about the private loans piling up in insurers' portfolios. Those state regulators have been keeping some of their thoughts to themselves. The National Association of Insurance Commissioners, the organization for regulators from every U.S. state in 2024, published a bombshell study revealing that the ratings on insurers' private credit investments were routinely inflated. Have we seen this movie before? Yes, we have. Last May, the group pulled the report from its website and said it needed to clarify its findings. That was an you-know-what moment right there. Nearly a year has passed, and the report titled "Private Ratings Among U.S. Insurer Bond Investments Continue to Rise and Have Nearly Tripled in 5 years" remains out of sight. But findings from the report produced by the NAICS's or the NAIC's Capital Markets Bureau have remained on the minds of insurers and their regulators. Its conclusions loom large now that many private credit investors, from deep-pocketed pensions and college endowments to wealthy individuals, have grown concerned about the financial health of companies taking out private loans. Big-name managers are facing numerous requests from individual investors to pull money out of private credit funds. Washington has heard those same alarm bells. The Treasury Department said last week it was planning a series of meetings with state insurance regulators that will allow participants to survey recent market events, emerging risks, and risk management practices, and outlooks for private credit markets. What's more, Egan-Jones Ratings, a credit ratings firm identified in the NAIC report as a frequent provider of private letter ratings for U.S. insurers, has been tangling with officials at the Securities and Exchange Commission. Last month, the SEC questioned Egan-Jones' capacity to consistently produce credit ratings with integrity. Again, where have we heard this before? Great Recession? Yeah, Fitch, Moody's, S&P. Hello, anybody? Inflated ratings on security assets? Anyone? Yes. Watch The Big Short, have we? So again, the SEC has questioned Egan-Jones' capacity to consistently produce credit ratings with integrity on some debt instruments that Egan-Jones was seeking permission to rate. The NAIC said in a statement to the Wall Street Journal that it took down the report because it was based on a limited sample of data, and there was a risk of misinterpretation by the public and the media. The group has since hired an outside consultant to help review its use of credit ratings to evaluate the risks of insurance investments. So they pulled it down. They said, hey, nothing to worry about, nothing to see here. But then at the same time, it hasn't been revised and they haven't put it back up. So the NAIC and state insurance regulators have been actively monitoring and progressively addressing insurers' evolving investment portfolios for many years. As private credit ascended from a Wall Street backwater to a booming market, the industry found the nation's insurance companies to be a ready source of capital. Private credit investments, which can include loans to businesses as well as pools of consumer debt, such as car loans or credit card debt, offered higher yields than plain vanilla corporate and government bonds. Credit rating firms often awarded those investments letter grades, saying they were just as safe. Again, where have we seen this movie before? As you guys can watch my eye roll going all the way back out of the end of my brain here. U.S. insurers are regulated by state commissioners who remit also includes home and health policies. Part of their job is to determine whether an insurance company is maintaining an adequate financial cushion based on the risk level of the investment it holds. Commissioners perform periodic examination of insurers' portfolios and rely heavily on credit ratings. These state regulators' duties grew more complex as private equity managers started snapping up life and annuity insurers and began moving their insurance money into private credit investments. Other insurers followed. Of the about $6 trillion in invested assets held by life and annuity companies, nearly $1 trillion is now in private credit investments, according to AM Best, a credit rating firm that rates insurers. So let me say that again. These life insurance companies, out of $6 trillion in assets, $1 trillion is now in private credit investments. That is unbelievable. Unbelievable. About $419 billion of that debt carries a so-called private letter rating. In some ways, such a rating resembles what the ratings firms provide for publicly traded bonds. The firm issuing or packaging the debt pays a ratings company to assign a grade based on the likelihood the borrower will repay it. Remember, okay, so they're paying, the firm is basically paying for the rating that they're going to get. Again, I say to you, where have we seen this movie before? This is the same thing that happened back in 05, 06, 07, 08. Basically, the Wall Street firms paying the rating agencies for the grade that they got so that they could sell their security instruments. The same thing. This is the same thing happening over again. And I said a long time ago, those rating agencies were never held to account. They were never held to account what happened during the financial crisis, and the same garbage is still going on today, still happening today. Investors, including insurance companies, can also seek a private letter rating for a debt instrument they hold, but unlike bond ratings, private letter grades are available only to the debtors, insurer, and investors. So, okay, and then we see here private letter ratings received by the National Association of Insurance Commissioners, large credit rating providers, and then small credit rating providers right here. So obviously the small credit rating providers just dwarf the large credit rating providers. I mean, just 6,988 small credit providers as compared to 1,164 large credit providers. And then we have it down here. So, but obviously, we're going to keep an eye on this. I guarantee you, there is a lot more that is going to come from this, from these meetings. I think when they begin to dig into what is on the books of these insurance companies, I don't think they're going to like what they're going to find. I'll just put it that way. We shall see there. But now, let me just share with everybody I want to share with everybody some private credit news that I have here. So, okay. So let's start with this. Okay, so Blue Owl, this is starting from Monday. So Blue Owl Capital is limiting redemptions to the 5% quarterly limit on 2 of its private credit funds on a pro rata basis after requests exceeded the available redemption capacity. Majorly exceeded, not a little bit, like blew right through that. Canada's largest banks have roughly 879 million to 633 million in loan exposure to Go Easy Ltd, a non-prime lender that has alarmed markets after a dividend suspension, pulled guidance, and a sharp jump in charge-off, Bloomberg News reported, citing calculations based on the firm's latest financial filings. So keep an eye on Go Easy. We'll see what happens with that. And now let's go to our next thing. And just bear with me. I have to kind of thumb through these pages here. Okay. Goldman Sachs Private Credit Corp narrowly avoided the surge in investor withdrawals that has forced competitors to cap redemptions. So reporting first quarter requests just below the industry's 5% limit, significantly lower than peers like Blue Owl Capital and Ares Management, Bloomberg reported. So Goldman Sachs barely dodged the redemption, the 5% redemption, but that probably will not hold here in the second quarter. Morgan Stanley is launching a new interval fund focused on private credit, even as the sector faces unprecedented redemption pressures and liquidity challenges for retail investors. So, I guess Morgan Stanley must know something everybody else doesn't. Miami, Florida-based fintech company PepperPay LLC filed for Chapter 7 liquidation in the U.S. Bankruptcy Court in Miami on March 31st. U.S. Herald reported, citing the company's bankruptcy filing, the bankruptcy petition revealed the company held just over $665,000 in assets, but owed more than $3.4 million, with the majority of its debt, nearly $2.4 million, owed to TSYS Acquiring Solutions LLC, a subsidiary of Global Payments Inc., the report said. And then let's keep on going here. All right, what do we got here? Private credit. Alternative asset manager Blue Owl Capital received a negative outlook rating from rating firm Moody's Corporation after significantly higher than peer redemption requests in the first quarter. Amid an investor exodus from the private credit industry, Bloomberg News reported. Moody's specifically downgraded its outlook to non-traded business development company Blue Owl Credit Income Corp. From stable, according to the report. And then let me see here if I have anything else here on the private credit front. I have one more thing. Oaktree Capital Management LP's exposure to software companies and direct lending remains limited amid mounting risk concerns about private credit. The asset manager's co-founder, Howard Marks, assured in an April 9th memo on the company's website, our exposure to software companies across the entire credit platform is extremely small on an absolute basis and relative to peers, Marks wrote. So, okay. As they say, we shall see. We shall see. All right, so that is the private credit front for this week. So let's take a look at some other things here real quick. So on Kalshi, so prediction markets. So court sides with Kalshi in ruling on prediction markets. So New Jersey gaming regulators can't regulate Kalshi. A federal appeals court ruled on Monday in a win with implications for how prediction markets are run. The court ruled that the Commodity Futures Trading Commission has exclusive jurisdiction over Kalshi sports-related events contracts in New Jersey, which the state had argued were unregulated and in violation of state sports gambling laws. The ruling by the Third U.S. Circuit Court of Appeals is one of the most significant decisions to date on the legality of prediction markets and the question of whether the CFTC, a federal government agency, is the only regulator with the power to police them. Kalshi and other prediction markets platforms are CFTC registered exchanges, allowing users to place bets in the form of a financial derivative known as a swap. The platforms have expanded into areas such as sports, sparking a legal battle between states and the Trump administration about whether such wagers are the same as online betting and should be regulated as such. This is a big win for the industry and millions of users, Kalshi Chief Executive Tarek Mansour said in a statement on social media. The loss for New Jersey also represents a win for the Trump administration, which has come to the defense of prediction markets as states seek to restrict how they operate. The CFTC last week asked federal courts in Arizona, Illinois, and Connecticut to block those states from applying their own gambling laws to the contracts. So the illegal battles around prediction markets no doubt will continue into the future. And then we also have this. So the White House warned staff against insider trading using Iran war information. The warning came amid a surge in large, unusual bets in the energy and prediction markets. So, a recent geopolitical events shake financial markets. Some traders are making risky bets to profit from the volatility. In an email on March 24th, the White House warned staff not to trade or place bets related to the U.S. war on Iran, including on prediction markets. The warning aimed to prevent any misuse of confidential information, the White House told the Epoch Times. President Donald Trump has been crystal clear. While he seeks a strong and profitable stock market for everyone, members of Congress and other government officials should be prohibited from using non-public information for financial benefit. Davis Ingle, White House spokesman, said in an email, the warning was in line with government ethics guidelines that prohibit the use of non-public information for trading activity. Ingalls added that any implication that administration officials are engaged in such activity without evidence is baseless and irresponsible reporting. The White House statement came after some media outlets reported unusually large trades in the oil markets ahead of official U.S. government announcements regarding the Iran war. Federal rules prohibit government employees from gambling or placing bets on sports or other events while on duty or on government-owned leases. Property unless such activities is necessary to their official duties. Okay. All that being said, I will say this. The White House did not put out this announcement to everybody for no reason. They put it out because they have a major concern around this. And it was obvious by the trades, bets, whatever you want to call them, whatever, but it was obvious by what it was put out that somebody was dealing with insider information and somebody made a bundle of money on this. There's no two ways about it. So it'll be interesting to see how this all continues to play out. You know, one of the legislative things out there right now is a ban from basically the prediction markets being able to place these type of bets on any kind of political or war-based, type gambling bets, whatever you want to call it. So we'll see. Again, we're going to keep an eye on this. I'll keep an eye on prediction markets that become big things. A lot of players like Coinbase, Robinhood, all want to get into, Susquehanna, all want to get in big time on prediction markets. So I'll keep an eye on it and see what happens. Interesting note here, mega mergers return to the food industry in the first quarter amid pressure for lower prices. The trend was underscored by Cisco's $29.1 billion acquisition of Jetro Restaurant Depot and McCormick's $44.8 billion deal with Unilever Foods. So again, some very big mergers in the food industry world, really shaking that up. So no doubt there. I'm not going to get into all the weeds on this one, but I just wanted to point that out. All right, let's talk about office buildings for a few minutes here. So I got these two articles here on office buildings. So a fire sale has U.S. office buildings going for 90% off. So from Denver to Washington, developers are seizing on huge discounts when buying troubled office towers. So America's battered office market is holding a fire sale featuring some markets marked down by more than 90%. So in Chicago, real estate developer Mark Calabria bought a 485,000 square foot office building for $4 million. The building sold for $68.1 million a decade ago. Developer Asher Luzzatto paid a mere $5.3 million for the Denver Energy Center after a foreclosure process. The two-building complex sold for $176 million in 2013. Even the federal government's landlord is getting in on the act. The General Services Administration last month sold a 940,000 square foot building to a residential converter for $24 million, a tiny fraction of its value a few years ago. Landlords and their tenants held on to their office towers for years, hoping for a turnaround after COVID. Now they are accepting enormous losses. Owners and creditors are capitulating to the reality that more employees are splitting their work time between home and office. They are also resigned to stubbornly higher interest rates, which lower property values and make it harder for buyers to borrow. borrow. People who don't know real estate would be shocked at the level of distress, Luzzatto said. Not every office building goes for a few pennies on the dollar. These are mostly poor quality buildings, often in undesirable locations, and owners of high-end office towers in the best locations of New York City and the hottest parts of San Francisco are actually raising rents and selling buildings profitably. But most office sales reflect the sector's steep decline. Even higher quality properties, on average, have dropped about 35% in value from their peak, according to analytics firm Green Street. Buyers, meanwhile, are picking up office towers in major U.S. cities for roughly the price of a three-bedroom condo unit in Manhattan. These distressed sales are paving the way for new owners to pursue redevelopment ideas that would have been unthinkable just a few years ago. Calabria in Chicago plans to convert the office building into an urban farm and education center. He is working with Farm Zero, which will use grow lights and hydroponic farming techniques to produce millions of pounds of years of berries, tomatoes, lettuce, herbs, and other vegetables. Rock bottom prices are also accelerating the move to residential conversion. Developers who bought at a steep discount can now justify costly structural changes, such as carving out atriums or reconfiguring floor layouts that would have been financially unworkable at higher valuations. At the start of the year, more than 90,000 apartments nationwide were in the process of conversion, up 28% from a year earlier. So that is a great segue to the next article here, which basically talks about office buildings are disappearing. There's one big reason why. So office to apartment conversions hit a record level with 90,300 units in development to start the year. More than 213 billion in office building loans are set to come due by the end of 2026. Distressed office assets trading at steep discounts are unlocking conversion deals today. Office buildings across the country are facing wrecking balls, and those properties increasingly are being turned into housing. A March report by Rent Cafe found that office to apartment conversions have reached a record level with 90,300 units in different stages of development as of the start of the year. The biggest cities lead the effort, including New York City, Washington, D.C., Chicago, and Los Angeles, and have helped boost office to residential conversions by 28% at the beginning of 2026 compared to a year earlier. The reason is simple. There is not enough demand for the office space available. That's a continuing legacy of the pandemic, which boosted remote work levels and pushed companies to reevaluate their office space use. Those decisions, in turn, have drastically cut the value of office buildings. The dynamic has pushed developers and municipal representatives in cities that heavily depend on office space for tax revenue to create incentives and programs to boost the conversion of less desirable office space. That comes as buildings across the country have ended up being abandoned by their owners or foreclosed on and sold for just pennies on the dollar, a cycle that's likely to be repeated as more commercial real estate loans come due. A massive amount of office loans, over 213 billion, are coming due by the end of 2026, said Doug Ressler, senior analyst and manager of business intelligence for Yardi Matrix, in the report. When loans mature, borrowers need to either pay them off or refinance them. The problem is that many of these office buildings have lost significant value, largely due to remote work trends reducing demand. The conversion noted by Rent Cafe are only a fraction of the nation's overall housing supply. Builders are creating about 1.5 million units a year. Meanwhile, new office space is still coming online, creating a bifurcated market where top-tier office space is highly sought after, while lower quality or less ideal office space is in much lower demand. A recent report by real estate firm CBRE found that 2025 was the first year that office space removals, whether through demolition or conversions, outpaced newly completed space for the first time since the firm began tracking the data in 1988. But the firm stressed that dynamic has begun to rebalance the market as drops in inventory have had the effect of driving down the vacancy rate for the first time since the pandemic. So again, I think this is all very interesting, and I have reported on what is known as the maturity wall, and the maturity wall has been a thing that has been created as banks originally started doing what was called extend and pretend a few years back, and now that has really pushed a lot of these refinancings out. But now it is time to pay the piper, so to speak, and banks are not willing to extend these loans any longer, seeing that basically these loans, these buildings have really decreased in value. Their rent rolls have dramatically deteriorated. The cash flow has gone down. And the cities want to do something about this, because obviously the owners, the first thing they do is run in and do a tax appeal, tax assessment, and basically try to lower their tax bill, because they're basically like, man, the value of my building's worth 90% less than it was a couple of years ago. I'm not paying you guys 25 million a year in taxes. Let's get that reduced to like 5 million. And so tax revenue in cities has dramatically declined because of that. And so they want to convert these buildings as quick as possible. So again, just a very interesting phenomenon to keep an eye on. So again, we're kind of seeing this real division between the haves and have-nots in the office space realm, right? The haves, the Class A office properties, still doing great. Very little vacancy. Rent rolls are strong. Building performance is fantastic. But then on the lower end of the market, as you get into you get through the B properties, but certainly what you would classify as the C and D properties in the commercial real estate space, those properties are in all kinds of problems, and they're getting dumped now left and right, which is opening the door for a lot of these redevelopment opportunities. So we'll continue to keep an eye on all of this. So okay. Now let's get into some SpaceX for a minute. So SpaceX lays out IPO details and targets early June roadshow, as being reported here by Reuters. So as I reported last week, this is shaping up to be one of perhaps the largest IPO of all time. And we finally got a little bit more detail here. SpaceX outlined the details of its highly anticipated IPO at a meeting with its team of bankers Monday night, telling them it plans to earmark a large portion of shares for retail investors and will host 1,500 of them at an event in June following the IPO roadshow launch, according to two people familiar with the matter. Retail is going to be a critical part of this, and a bigger part than any IPO in history, Chief Financial Officer Brett Johnson said during a virtual meeting. The two people said, asking not to be identified because the discussion was private. But Johnson said the large retail component is by design, as those are folks that have been incredibly supportive of us and of Elon Musk for a long time, and we want to make sure that we recognize that. Reuters reported last month that SpaceX is rewriting the IPO playbook with a large retail portion in the offering. The meeting brought together the full syndicate for the first time as part of the process for what is expected to be the biggest initial public offering ever, as the rocket maker seeks to raise $75 billion, valuing SpaceX at as much as $1.75 trillion, Reuters has previously reported. So again, very interesting details here on SpaceX, and obviously we're going to keep an eye on this. This is going to be, when this happens in June, it's gonna June or early July, it's gonna be massive. Now here, this was very interesting. So I reported on last week that Elon wanted to, he wants to make this new chip plant in Texas, which would make chips for basically SpaceX and Tesla. Now, I was basically at the moment, I was kind of like, man, how's he going to do this? This seems kind of crazy. I don't know if this is really going to work out the way he thinks it is. But then he did something very shrewd. He decided to partner up with Intel. And Intel, who obviously is, Intel's been a little bit down on their luck. They've just, every time they seem like they're going to turn a corner, they seem to go the other way. But Intel, who obviously has a lot of experience running fabs, and I think would be a perfect partner for them on this, they are going to step in and basically help them run this new terafab project that's planned in Texas, which I think this is a home run decision by Elon Musk here. So Elon Musk is partnering up with Intel on his ambitious terafab project, which aims to build specially designed chips for SpaceX and xAI, as well as for Tesla. In an announcement Tuesday, Intel said it would work with the companies to design, fabricate, and package ultra-high performance chips at scale. The company also shared a photo of Chief Executive Lip-Bu Tan shaking hands with Musk, CEO of SpaceX and Tesla. The partnership is a win for Intel, which has struggled in recent years, leading the company to cut its production capacity when demand was surging for data center chips and when competitors like NVIDIA and AMD have thrived. Last year, the Trump administration reached a deal to acquire the equity stake in the company for around $9 billion to help secure the American chipmakers business. The U.S. government held 8.4% of Intel's shares outstanding as of March 20th, according to securities filings. The figure doesn't include warrants that could increase the government's equity stake in Intel. Shares in Intel gained more than 3% in Tuesday trading. So again, big news here for Elon, and we will keep an eye on this and see what happens. And then also, I wanted to share this just because I thought it was interesting. So there's a big trial that's about to take place here in the next couple of weeks with OpenAI and Elon Musk. Okay, so Elon Musk now, he's kind of changed a little bit of what he wants if he wins, and I thought this was really interesting. So basically, Elon is saying, if I win, I don't want any money, but what I want is I want Sam Altman gone. I want him out the door if I win. So Elon Musk seeks ouster of OpenAI CEO Sam Altman as part of lawsuit. So Elon Musk is seeking to have OpenAI CEO Sam Altman and President Greg Brockman removed from their roles as officers in the company as part of a case expected to go to trial later this month. In a Tuesday filing, Musk's lawyers laid out specific remedies their client is seeking if a judge and jury determine that Altman and OpenAI defrauded Musk. Jury selection for the case is slated to begin on April 27th in a federal court in Oakland, California. So basically, Elon, again, like I said, is basically saying, hey, look, I don't want money. I just want Sam Altman and Greg Brockman. I want them gone. If I win this, they're gone. Which again, I think that adds a very interesting thing here, because I think if a jury does conclude that these two did defraud Musk of this, he's not asking for money. He's just saying, I want them gone for defrauding me. I would think a jury would yeah, if he wins, I think that they would be very, very open to granting that request, considering that it's not a monetary judgment. It's basically like, yeah, these two guys are crooks, they're creeps, they defrauded him, they basically pushed him out of this company, took this from him, changed the initial purpose, and so they're gone. They're gone. So again, I think this is a fascinating strategy on the part of Elon, and I think this is going to be one interesting trial, just like the social media trial with Meta and YouTube. I can't wait to watch this one. This is good. This is going to be a good one. It's going to be very highly entertaining. So, and then I wanted to point this article out here for a minute. So your next stock report could be written by AI agents. Anthony Pompliano, crypto influencer and entrepreneur, is launching a business focused on AI-generated research notes. So champions of artificial intelligence say the technology is poised to take over some of the most traditional titles in finance: stockbroker, portfolio manager, financial advisor. Now it is coming for the Wall Street research teams cranking out daily stock reports. So says crypto influencer and entrepreneur Anthony Pompliano, whose company ProCap Financial is launching a new business focused on AI-generated research reports for individual investors. The plan is to have a fleet of AI agents scanning the markets, analyzing trends, and drafting reports with titles like 3 stocks that win from both tariff refunds and the Iran oil shock, according to an example shared with the Wall Street Journal. The agents could also generate a report comparing the performance of buyback and dividend stocks, according to the company, or react within minutes to a White House press conference. We think that AI agents are very good at finding undiscovered or uncovered insights in financial markets, but they also are very good at producing large amounts of well-written research faster and cheaper than humans. Pompliano said, my guess is that the entire industry is moving this way. Shares of ProCap Financial were down more than 2% in early Tuesday trading. The agents are capable of generating hundreds of reports a day, Pompliano added, but the company will start by circulating just a few daily to avoid flooding investors' inboxes. Reports distributed by the service, called ProCap Insights, will cover single name stocks, thematic trends, and macro analyses, and won't offer any specific buy or sell recommendations, according to the company. A ProCap Insights annual subscription will cost investors $2,500 a year. So again, I just find this very interesting. And while, again, AI has traditionally been focused so far on stockbrokers, portfolio managers, and financial advisors, now it's going after the research analysts that produce all the research reports here on daily, weekly, monthly, annual basis. So again, it's just very fascinating to keep an eye, again, we just got to keep an eye on some of this stuff here. So, all right. And then some other banking news here as we get a little bit closer to the end here tonight. So Bolt lays off roughly 30% of staff in an AI push. So the workforce reduction affecting less than 40 people, according to the company, marks the fintech's fourth round of cuts since 2022 amid a sharp valuation drop and the return of its founder. So I just thought that was kind of interesting. Florida de novo gets FDIC's conditional approval. So Portrait Bank submitted its application in September. It has raised $42 million from 248 local investors and aims to begin servicing businesses, consumers, and private wealth clients this year. So, and again, I thought this was great to point out because it's a perfect example of the things that I have talked about in the past as far as like the hurdles to one of the biggest hurdles to starting a de novo bank is being able to raise enough capital. And I said, you're generally going to have only, you're generally only going to have a pool of investors somewhere in the neighborhood of probably 300 to 400 investors tops. And you're going to need, what is now roughly probably about $26 million to basically start a bank. I've always said that to give yourself a realistic shot, you probably need at least 30 million. But here, 42 million raised from 248 investors. That's perfect. That is like right in the sweet spot. So I think that's great on the part of this startup here. So a bank in Winter Park, Florida is set to become the first new de novo in the central part of the Sunshine State in nearly a decade, having received conditional approvals for both federal and state regulators. The FDIC and Florida Office of Financial Regulation has handed Portrait Bank conditional approvals. The bank announced Wednesday. Portrait submitted its application in September, having raised some 25 million by that time. Now it has raised 42 million. Portrait Bank's vision has always been clear: help local entrepreneurs and businesses frame their financial futures. Founder and CEO Eric Weiner said in a prepared statement, "Our goal is to create a long-lasting, trusted partnership with our clients, offering them the resources they need to succeed. Reaching this step of regulatory compliance is a pivotal milestone that brings us closer to working with underserved businesses and members of the Central Florida community." So again, great news for them. Best of luck. I hope they knock it out of the park. Okay, cash management platform Lorem applies for national trust charter. So we're basically building a new age BNY, said George Davis, the company founder. So this is, again, another interesting thing here. So Lorem has applied for a national trust charter with the Office of the Comptroller of the Currency, the OCC. According to the document shared with Banking Dive on Tuesday by the multi-currency clearing and cash management platform, a national trust charter would give Lorem the chance to apply for a Federal Reserve account, releasing it from reliance on a partner bank and enabling it to launch more fiduciary services, said Greg Davis, told Banking Dive. What we're building is a bank for other banks, Davis said. We're basically building a new age BNY. Lorem operates out of Dubai as a specialist correspondent institution, providing clearing, custody, and cash management for regulated financial firms such as payroll operators and payment services providers. But the company is moving to New York City to the proposed headquarters of Lorem National Trust Bank, according to the filing. Lorem's customers are largely European financial institutions and small to mid-market U.S. banks and payment companies, but Lorem helps customers move U.S. dollars all over the world, he said. So again, just very interesting. Looking to become a new age BNY, Bank of New York Mellon, for anybody who doesn't know. So again, just very interesting. So we'll keep an eye on that one. Upstart, the name is a fintech, as the name of a company. So I know a lot of people probably hear that. What is the world? So Upstart sued over AI models overreaction. So investors accused fintech executives of misleading them for adjusting revenue projections upward, debuting over responsive AI, and then needing to forecast downward. So not everything in AI turns to gold, my friends. So yes, we got that there. Then we go into Fed mulls FedNow cross-border use. So the Federal Reserve proposed letting participants in real-time payment system use intermediaries to make cross-border fund transfers. So the Federal Reserve Board on Wednesday proposed letting banks that participate in its FedNow real-time payment system use intermediaries in addition to reserve banks to send money through the services. In a website post about the proposal, the central bank asked for public comment on the idea, allowing U.S. financial institutions the ability to tap such intermediaries, including a non-U.S. correspondent bank, is expected to let FedNow participants complete payments in the U.S. and internationally, the Fed said. In a vote on Tuesday, the board unanimously supported the proposal. So again, interesting developments there with FedNow. So we'll keep more of an update on that. Chime makes an upmarket move. So the fintech lets users who put $3,000 or more per month in direct deposits into their account receive 5% cash back on a spending category and a 3.75% annual percentage yield on savings. So Chime is still paying up to buy those customers. The question is, how much longer can they do that? So it's interesting. So we'll keep an eye on that one. White House continues campaign to gut CDFIs. So a Trump administration budget request cuts 63% of awards to community development financial institutions and demands a focus on rural assistance, not immigration, gender, and climate radicalism. So the White House on Friday proposed cutting $204.5 million in discretionary awards to community development financial institutions for fiscal 2027. That represents a 63% cut of the program's funding. The budget request leaves $119.5 million in the CDFI fund. However, according to the housing nonprofit enterprise, $100 million of that would go toward a new program meant to stimulate economic development in rural communities. The remaining $19.5 million would support the Rural Financial Assistance Program, the New Markets Tax Credit, and the closing out of unfunded CDFI programs, according to requests. The White House, in the budget request, railed against previous iterations of the CDFI fund, saying past administrations abused it to advance a partisan agenda. Past awards enabled lender practices in which race was a key determinant in access to loans and provided funds for products and services that advanced immigration, gender, and climate radicalism, the document read. The White House said it aims to refocus CDFI funds awarded to expand access to capital, finance infrastructure, and bolster Main Street business development in rural America. At the same time, the Trump administration said it would avoid funding wind power, bonds that allowed non-citizens to be released from immigration and customs enforcement custody, and what it called gender extremism, including LGBT plus or 2PQ plus clinics that provide gender reforming hormone therapy. The budget request is non-binding. For example, last year, the White House requested cutting the CDFI fund to $134 million. Congress, however, rejected the plan and kept the fund at $324 million as it had for fiscal 2025. At least two trade groups for financial institutions came out in support of a more robust CDFI fund. So we'll keep an eye on that one and see what happens. And then I have JP Morgan's Diamond bemoans part of Basel GSIB proposals. While the bank CEO backs a timely finalization of the proposals, the latest iterations are still very flawed in a few specific areas, Jamie Dimon wrote in his annual letter to shareholders. So more to come on that. I said keep an eye out this week for my episode that will be covering Jamie Dimon's annual shareholder letter. I'll get into all this and a lot more in that episode. And then just a few more minutes, I just want to run through a couple more things here. So White House downplays the stablecoin threat on bank deposits. I talked about this for a few minutes earlier. So basically, again, the White House came out with this report basically saying that, hey, look, there really isn't as much a threat to stablecoins as perhaps what was portrayed or what we thought. The impact will be very negligible, and that basically everything should be okay there. Whether you buy that argument fully or not, I'll leave that up to you. FDIC sets stablecoin standards for banks. So the FDIC's latest stablecoin proposal is setting standards for banks looking to engage with the payment type. So again, I will go over this in much more detail just a lot of different things, but I'll just read this one paragraph. So the FDIC board on April 7th unanimously proposed a rule imposing requirements on permitted payment stablecoin issuers in areas such as permitted activities, capital, reserve assets, redemption, and risk management. It is the agency's second proposal moving to implement the guiding and establishing national innovation for U.S. stablecoins, otherwise known as the Genius Act. Before the deadline in July, following a December 2025 proposal establishing an application process for banks. So again, I'll give this a lot more coverage here. U.S. banks see a rise in commercial and industrial loan, also known as C&I loan, delinquencies in the fourth quarter of 2025. So U.S. banks' commercial and industrial loan delinquencies rose in the fourth quarter of 2025, even as total portfolio volume remained largely unchanged. The value of delinquent C&I loans rose 6.3% quarter over quarter and 7.2% year over year to $33.28 billion in the fourth quarter of 2025, an increase of more than $2 billion from the start of the year. The C&I loan delinquency ratio stood at 1.39% in the fourth quarter of 2025, up 7 basis points from the previous quarter and 8 basis points from the same period a year earlier. The delinquency rate for all loans and leases was 1.56%. So again, this is not a good trend. This is not a good trend, not where you want to see this trending. That is for sure. So we have to keep an eye on this one. U.S. banks deal closing timelines outpace, or I should say, big U.S. bank deal closing timelines outpace smaller transactions. Large U.S. bank deals are closing at a faster clip than smaller transactions and all bank deals as a whole. So that is good news. So we're seeing bigger deals closing at a faster clip. Non-banks dominate bank charter boom as approval timelines shrink. So non-banks are coming in droves to apply for national bank and national trust bank charters, capitalizing on the quick approval process. Just 3 months into 2026, and 13 bank charter applications have been filed, a pace on track to surpass 2025's total of 33 and mark the busiest year since at least 2018. Non-banks and some foreign banks looking to enter the U.S. are inflating those numbers as they increasingly seek national bank and national trust bank charters with the OCC. Of the 13 bank applicants filed so far this year, 5 are for non-depository trust entities seeking national trust bank charters, and 4 are for national bank charters. So again, it's very interesting here. I've talked a lot about this, and we will continue to keep an eye on that. Securities grow at U.S. banks end the fourth quarter of 2025. Momentum does return, though, in early 2026. So U.S. banks continue to rebalance security portfolios in late 2025, but loan growth and cautious rate positioning led to a modest pullback in the fourth quarter, despite improving valuations. But aggregate debt securities, U.S. banks fell 0.5% or $26.37 billion during the quarter to $5.699 trillion, ending a 5-quarter growth streak. Aggregate trends were primarily driven by the largest banks, particularly Bank of America and JP Morgan Chase. On a median basis, the industry recorded only 1 quarter of growth each year since 2022. Bank of America and JP Morgan Chase decreased security balances by 1.4% and 0.8% respectively during the quarter. Among the 20 largest banks by debt security balances, Capital One reported the highest increase, up 4.7% to $93.58 billion. Nearly 55% of banks reported a quarter-over-quarter decline in debt securities. So again, interesting development there on that. Federal regulators ease banks' credit union anti-money laundering requirements. Again, I will talk more about this in the coming weeks. But 2 federal bank regulatory agencies and the National Credit Union Regulator are moving to ease institutions' anti-money laundering requirements and supervisions. So yes, we'll keep an eye on that. FDIC and the OCC ease reputation risk definition and final rule. So this is all on the debanking argument. So the FDIC and the OCC's final reputation risk rule broadened the definition of what constitutes reputation risk. The agencies on April 7th unanimously finalized their reputation risk removal rule. The final version now includes operational condition in the definition of reputation risk, acknowledging that some operational risks that are out of a bank's control would still harm an institution. Operational risk is a significant concern, and operational issues such as a cyber attack or a natural disaster could have a direct impact on customers' willingness to do business with an institution, the agencies wrote in a memo. As such, the agency's new definition of reputation risk is anything that could negatively impact public perception of the institutions for reasons not clearly and directly related to the financial or operational condition of the institution. The October 2025 proposal only mentioned the financial condition. The agencies have decided to add operational into the final rule. The final rule read, the agencies agreed that operational risk is a significant concern for institutions. Refocusing supervision to material financial risk has been a focus for all three federal bank agencies under the new administration. In a statement on the final rule, FDIC Chairman Travis Hill continued to voice support for that initiative. So again, big developments on that front. And then finally, Trump accounts designation is a victory for Robinhood and BNY Mellon. So Capital Alpha Partners analyst Ian Kratz said the designation of Bank of New York Mellon and Robinhood Markets to support the Trump accounts program is seen as a victory and a boost for the firms. So the U.S. Department of the Treasury designated BNY as the financial agent that will manage the initial accounts and help develop the Trump Accounts app. Robinhood will serve as brokerage and initial trustee, according to a news release. There was initial skepticism about the program, which provides qualified American children with a tax-advantaged investment accounts, but now the investment community has started to see it as a potentially creating millions of new investors. So the move particularly broadens Robinhood's reach, the analyst said, also noting that the company's selection was unsurprisingly given how enthusiastically it has supported the program since it was unveiled. For BNY, landing this role marks a comeback after losing its Treasury contract as financial agent for the Direct Express prepaid debit card program in 2025. So big news there. And yes, I think that's big wins for BNY Mellon and Robinhood. So, all right, man. Whew, I'm exhausted, man. Well, that's a lot. That's a lot of news, man. And to think we only have like 4 more hours to go. I'm just kidding. I kid. All right, let's go into wrap-up mode here. I'm going to go over my items here that I always go over at the end, and then we'll do our story of the week and our quote of the week. So if you are listening on Apple Podcasts or Spotify, please leave me a review. That would really, really help the channel out. So reviews, positive reviews on Apple Podcasts or Spotify. So we love that. Make sure to check out thebankernextdoor.com. Visit the website, all kinds of great stuff on the website. You got podcast archives on there, articles, all kinds of good stuff. Please go check out the website. Make sure to subscribe on YouTube if you want the latest and greatest updates and announcements here on the channel. Subscribe on YouTube to get all those. You can email me at info@thebankernextdoor if you've got questions, comments, topic recommendations, all that. The best way to get me, info@thebankernextdoor.com. Send me an email. Make sure to follow me on Getter X and Truth Social. I will tell you that I spend the bulk of my time on X, but you can follow me on any of those platforms. I'm posting stuff all week long up on there. And remember that BND is on YouTube, Rumble, and all major podcast platforms. New episodes every week, Monday through Friday, premiering at noon. And BND Strategy Room live stream is every Saturday night here on YouTube at 8 p.m. Coming soon, very soon, to other platforms. We'll be doing live streams on Rumble and X very soon. In next couple weeks, that will be happening. So very, very excited about that. Okay. All right, so that's that. So now let's go to our story of the week, shall we? So this week's story is about payment for order flow. Now, payment for order flow is very controversial. It has been a very big topic on Wall Street. There are a couple of books, Flash Boys, that I've really been wanting to get into. I just haven't had a chance to get to yet. But there's also dark pools. So, but again, let's focus in on the payment for order flow is the compensation and benefit a brokerage firm receives for directing orders to different parties for trade execution. The brokerage firm receives a small payment, usually fractions of a penny per share, as compensation for directing the order to a particular market maker. For options trades, the market is dominated by market makers, since each optionable stock could have thousands of possible contracts in existence. Payments for order flow is basically ubiquitous for options transactions and average less than 50 cents per contract traded. Payment for order flow describes what has become a major source of revenue for both traditionally large broker dealers like Charles Schwab and Robinhood, as well as online trading platforms like Robinhood. Transaction fees for equity and options trades were fundamental sources of revenue for the major brokerage firms until 2019, when Charles Schwab shocked the industry by eliminating those fees entirely with $0 commission trades. Competitive pressures caused other large discount brokers to soon follow suit. This and other economic factors increased retail participation and trading volume in the market, thus creating an opportunity for other sources of revenue. In its IPO filing, Robinhood disclosed that 81% of its first quarter revenue came from payment order flow. While payment order flow is an accepted method for compensating market makers for the risk they take to make facilitating an orderly market in equities and options, the practice can potentially involve conflicts of interest if the broker-dealer steers transactions in a way that serves their financial interests over those of their trading customers. Yes, that would be called front running. If you decide to front run your customers, you're basically shafting your customers. Yes, not a small thing, not a small thing. So again, see the books, Flash Boys and Dark Pools. Like I said, I will be talking about those books, but that is payment for order flow. And just remember something. You get, you're out there trading, right? You're on Charles Schwab, you're on Robinhood, you're on whoever, and you're paying $0 for those trades. And you might think like, oh, this is wonderful. I would just remind you, you do not get anything in this life for free. And Wall Street is not interested in giving you anything for free. So there's always something else going on. So, and the reason why you're getting those payments for free now is because they are selling your trades to people like Citadel, who are then processing those trades and making billions of dollars off of them. Okay, and there are times when you are being front run on your trade, and that is costing you money. You don't recognize it. It's pennies, it's fractions, but it is costing you money whether you realize it or not. So again, just to put that out there, there will be more to come on that topic. Be sure of that. And then finally here, our quote of the week comes from the great basketball coach John Wooden. So don't measure yourself by what you have accomplished, but by what you should have accomplished with your ability. So fantastic quotes from John Wooden. Again, don't measure yourself by what you have accomplished, but rather by what you could have accomplished with the ability that God gave you. So, all right, that is it for this week. I thank everybody so much for hanging out with me again on a Saturday night. I hope everyone has a great weekend out there. Have a fun time watching the Masters. My gosh, there's just so much going on right now in the banking world. Is just unbelievable. So there's so much to follow up on week in and week out. New stuff coming all the time. So again, I will be back next week with another fantastic episode. I can't wait to be back in the strategy room with everybody. Until then, like I said, have a great weekend. Have a great time watching the Masters, and I will see everyone again next week. Take care.